U.S. stocks on pace for their best week in 16 months. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to closing bell here in the U.S., we have another rally on our hands. You take a look at the S&P 500, about 1.2% right now. Big tech even more so. NASDAQ 100 up by 1.3%. Of course, helps a lot that October jobs report came in cooler than expected. Of course, maybe fueling bets that we really are seeing peak Fed rates, and you can see that reflected in the bond market as well, with that 10-year Treasury yield dropping almost 11 basis points. We actually briefly broke below 450 earlier today. I remember when we were at 5% because it was just last week. You take a look at the dollar right now, not having too great of a day, of course, as yields drop. The Bloomberg Dollar Index down by about 0.9%, Romaine.
All right, well, Katie, I'll take your 10-year yield, and I'll focus in on the 2-year yield, the more Fed-sensitive 2-year Treasury, setting up for the biggest weekly price jump in 2 months and the first back-to-back weekly gains we've had going back to late April, early May. That's a good thing for investor Stan Druckenmiller, who last week disclosed a massive leverage position in the 2-year, and then, of course, spent the next few days taking jabs at the U.S. Treasury for not taking advantage of near-zero interest rates to sell more longer-term bonds. Now, Janet Yellen went on CNN Thursday pushing back, saying her department has actually increased its duration. And then Druckenmiller today pushing back on the pushback, telling Bloomberg that her measurement of average maturity actually overstates duration if you account for the $8 trillion of public debt of the Fed's balance sheet. Sonali Basak had a great sit-down interview with Druckenmiller, and we're going to dive a little bit deeper into that during the show. Now, Druckenmiller not only was critical of the Treasury, but of the Fed, too, saying last week that Powell talks a good game, but let's see what kind of game he's talking about if the unemployment rate is at 4 or 5 and going north. No response from Powell, but we are awaiting plenty of Fed speak today. That includes Vice Chair Michael Barr, Minneapolis Fed President Neil Kashkari, and a sit-down interview in the next hour with Atlanta Fed Chief Raphael Bostic right here on Bloomberg Television. Now, of course, all this is happening against the backdrop of the latest U.S. payrolls report, a tick up in the unemployment rate combined with a leg down in the number of jobs, creating added fuel to that argument that the Fed should make its rate hiking pause permanent. Wells Fargo chief economist Katie Greifeld, Jay Bryson was even blunter, saying, put a fork in it. They are done.
Put a fork in it. Well, the market is pricing in something a little bit greater than that. Not only are they done, but if you take a look into what's priced into 2024, clearly bond traders betting now more on rate cuts. 92 basis points of cuts priced into 2024. You can see that those cuts had been getting priced out of the market over the past couple of months. Of course, when we saw that big sell-off, especially at the long end, some of that, of course, is being taken back now, helped by what we heard from Powell on Wednesday and, of course, what we saw this morning at 8:30 a.m. as to what's happening in the labor market. But what could complicate the Fed's efforts here is what's happening in financial conditions, because we heard from Powell on Wednesday saying that tightening in financial conditions is helping to do the Fed's job for them. And take a look what happened. Of course, financial conditions bounced right back as we saw that big rally in stocks. We saw that big rally in bonds. So what that means for the Fed's path forward remains to be seen, Romaine.
Yeah, of course, all this against the backdrop of that jobs report, 150,000 jobs created on the non-farm basis here. Of course, that was well below what the street was looking for, well below what most economists are looking for, and the unemployment ticking up here to 3.9%, causing some concerns here about whether the Fed maybe did too much, too fast. Tom Porcelli joining us right now. He's the chief U.S. economist over at PGIM. And Tom, let's start off with these numbers here. Obviously, they're not bad under any other circumstance. I think we would take 150,000 jobs created. But given the pace of where we've been for a good portion of the last couple of years, are you concerned right now that maybe the labor market is softening too much?
Yeah, I mean, so thanks for having me. Good to be with you as always. Look, I think we have to be aware of a couple of important ideas. Yes, there's no question that job growth is slowing from incredibly elevated run rate, even just at the beginning of the year. But I think what we have to recognize is that the slowdown is actually, it's persisting. I've said this to you and to many others, but it bears repeating. If you just take out healthcare, these numbers look actually pretty poor. Even adjusting for the UAW strike, you're looking at about 100,000 jobs on average, even a little less than that, actually, over the course of the last few months. So I think that you're getting into a scenario where you're now getting, pretty close to the replacement rate, right? You're getting closer to the replacement rate, meaning, you really start to see the unemployment rate start to drift higher. And make no mistake, we already have. I mean, again, I think people are glossing over the fact that, we've now had a 0.5% rise in the unemployment rate.
Yeah.
That is small. I think you all know the Psalm rule well. I think you've had her on. You're getting close to triggering that. So I think that there is some real weakness here, and I think it really just drives home that sort of the Fed's more dovish tone over the course of last several weeks. I think has been warranted.
Mm-hmm. It certainly has. And I think when you look at on the services side and the manufacturing side as well, Tom, it gets to the idea here as to what the Fed can do. If they do think that we are sort of sliding towards recession or maybe something close to it here, do they have any real levers to pull other than just standing pat for the time being?
Yeah, look, our longstanding call at PGIM has been that the Fed will cut rates in 24. Obviously, given the recent round of data, we feel pretty emboldened by that. I think the question will become, and I think this is something that I think you both highlighted at the top of the hour. I think the question is going to become, to what extent is the Fed going to cut rates in the coming year? We have been saying you can see up to three cuts in 24. Look, that's going to be incredibly dependent. That's our baseline view. But that's going to be incredibly dependent on what happens from a labor market perspective. I mean, if you continue to see further meaningful deterioration from here, the Fed will do more. I mean, in fact, one of the things I think is probably important for everyone to be mindful of is, to me, one of the real risks. Again, given our baseline, we think that a few cuts is warranted. But I think you have to wonder what Powell's reaction function will be if labor continues to soften, and if he'll cut more than is warranted by the data. I mean, I think that's a fair question for the market to consider as we roll into 24.
Hold that thought for 1 second here. In conversation with Tom Purcelli, Chief U.S. Economist over at PGIM. Some breaking news crossing the wire. This coming out of the Treasury Secretary of the U.S., Janet Yellen, who's saying that they are laying the path for non-bank finance firms to get Fed oversight. Of course, there's been a lot of discussion about the growth of private equity, of private debt, and the big role that they play in our economy and whether there is actually some degree of systemic risk. Here's what we're learning right now. Our Bloomberg reporters are learning that Yellen, who leads the Financial Stability Oversight Council, they met and they have decided that there is a need for an expansion of too big to fail and that it should bring with it a certain number of non-bank finance companies under that umbrella. Katie Greifeld, that's the redhead crossing the wire. I'm not sure this is surprising, but I do know it's going to be controversial.
Big time. I mean, again, this follows months of back and forth, and we know that those non-bank institutions that might get designated here, they don't want this. We've seen lobbying efforts to that effect. You think about the compliance costs, the regulatory headaches that would follow, and it makes sense that we've seen this push. But according to this reporting, clearly, Janet Yellen forging ahead. And
we should point out this is going to be a long process. We're kind of talking right now about an outline or a framework, if you will, that they're effectively presenting at this meeting. This is something that, of course, the Treasury Department itself is going to have to come to terms with in terms of what it wants. They're going to have to reconcile that with other regulatory agencies, including, obviously, the Fed. And then, of course, you're talking about rulemaking, which, of course, will be up against a lot of industry lobbying. So it could be quite some time before we actually see this come to fruition.
And it'll be interesting to see which specific firms get named here. Of course, we're going to have to report that out. But if you look at some of the trade groups that have really come out against this, it's the Investment Company Institute, it's the Managed Funds Associations, the Mortgage Bankers Association. They've all been urging regulators to basically take a breath here, proceed carefully on this. And like you said, this will take a while, but clearly not going in their direction.
This has been, and I'm sure you know this, and what you cover as well, Katie, both on and off the air. This idea, this is really about the size of this industry, of the private equity, private credit industry, and the idea here that they're not this monolith, this tiny monolith anymore. They are behemoths. They are intertwined with the traditional banking system in a lot of ways. Let's face it, a lot of these private capital firms, they're getting deals done at the request of a lot of the more traditional banks here and vice versa. So there is an interconnectedness here that I think the Fed and, for that matter, other regulators have to be mindful of.
I mean, that's been one of the biggest stories of the year. The boom that we're seeing in private credit, that growing to a $1.6 trillion industry, really taking market share away from the banks. This is the flip side to that.
Absolutely. Interesting story here. And one of the reporters on the byline of that story, joins us right now. Katanga Johnson, our Bloomberg banking regulation reporter down in Washington. And give us a sense here, Katanga, first as to what this is right now. Are we talking about this is just an idea that isn't coming out of Yellen's head, or is this something actually being put to paper and they're ready to try to move forward with it?
This is certainly an actual blueprint that the regulators will vote to adopt on today. All of Biden's financial regulators, including heads of the Treasury, the Securities and Exchange Commission, the Federal Reserve, and others. And what this blueprint, these powers allow for the regulators to do is to assess whether a firm, not just its activity, but a particular firm may be engaged in activities that may be systemically important. And regulators will be able to sort of say to that firm, hey, we demand you to provide more data, more details, a better understanding of your balance sheet, certain risks that you face, so that we can assess whether all of that combined poses a risk to the financial system. Before this particular authority is granted to regulators, they were only able to, from a distance, assess whether a particular activity or sector's behavior was systemically important. Now, today, this gives them the opportunity to really look at a particular firm.
And so this blueprint, this is one step in the process. Give us a little bit of a sense of the timeline from here, from when this goes to blueprint into actual oversight.
As early as next week, regulators could begin, each individual financial regulator could begin to study firms that fall under their purview, and they can make recommendations to the FSOC to potentially designate a particular firm. But even before that firm is given this too big to fail label, regulators would have to, as a panel, maybe, the last time the FSOC did this, it took about 1.5 years to designate a firm. But there is an engagement about understanding the submissions that firms will make, as well as sort of giving that firm an opportunity to defend itself even after it's considered systemically important. So it's a long way here before firms are actually given the tag.
Just one last quick question here, Katanga, because I am curious. Earlier this year, I think it was in either March or May, when the Financial Stability Council when the Fed put out that report about systemic risk, and they devoted a lot of time in that report to talk about private capital and the systemic risk that it posed, and it very definitively, and I should point out this was a staff report, but it very definitively said that it did not find any systemic risk. They said that the industry was still too small and not as quite intertwined with intertraditional banks to pose a threat. Has anything changed between now and then?
It's interesting. We know that the FSOC has a particular panel, a task force that's focused on hedge funds, one that's focused on non-bank mortgage servicing. And that's just at the panel level. Individual regulators have been studying these issues around private credit, and particularly looking at, which of the firms that could potentially be the most risky, and how do we wrap our hands around them. It's too soon to say exactly what those studies and findings since this report has been published are, but we know that the powers today allows the agencies to go full steam ahead and looking even deeper, right? And kind of understanding, well, maybe that was the case then. Has that changed? And maybe even more regularly requiring firms to disclose to the regulators themselves.
Katanga Johnson down in Washington, one of the reporters on the latest story here. Janet Yellen and the rest of the Financial Stability Committee looking into expanding the umbrella of what constitutes too big to fail. Let's continue the conversation right now with the focus on the markets and Keith Lerner, Chief Market Strategist and co-CIO over at Truist Advisory. And Keith, I do want to just start off here with a very brief question about the news that we just learned. And this is really a broader question about how you view the health of our financial system right now, and whether you think that, I guess, the current crop of regulations that we have are enough protection for investors and, for that matter, the economy alike.
Yeah, well, first, great to be with you on this Friday. Nice to see green on the board this week. And more specific to your question, I think the banking system is very healthy. I mean, we've gone through the ringer as far as after the financial crisis. Capital ratios are much stronger. But what we have seen over recent years is a lot more money going into the private debt markets. And it's just more uncertainty, a little bit more murky. So having a little bit more, look through to understand what's happening there, I think could be helpful. Of course, there's going to be a debate about how much and how that looks like. But I would also say that's why I think some of the traditional indicators like loan growth that people tend to look at as far as the economy has been less useful more recently. And it's probably because so much is moving out of the traditional bank system into these private credit markets and so forth.
Keith, that's a great point, especially when you think about how closely we've been scrutinizing some of that loan data for proof that credit is tightening. But let's bring it back to the public markets, because we are seeing such an amazing rally this week in the stock market, particularly in the S&P 500, on the back of some words from Jerome Powell, on the back of what we saw out of the U.S. labor market in October. Do you think that translates into a 6% rally in the S&P 500 on a weekly basis? Does that make sense?
Well, in some ways, I do think the rally makes sense. In fact, last Friday at the lows, we came out with a report that was titled "Pullback Equals Opportunity." And part of the reason for that was we had a 10% correction in the S&P. When you looked more broadly, we saw places like small caps down 18%, real estate down 20%. So there's a lot of bad news. And then last week, we brought down the winners. The Mag 7 were brought down as well. And then sentiment got very depressed. So when you get so stressed and have such a deep kind of pullback, a little bit of good news can go a long way. And we had that catalyst this week, as you mentioned, with Powell, with the employment. And the most important fact in our view, part of the reason for that call last week, was that we thought rates would start to stabilize as you neared 5% on the 10-year and real yields hit around 2.5. So the main story this week is those yields coming down. And I think that's a positive. 6% in a week, it's a year's worth of gains. But again, I think from where we were, it makes some sense to us.
Let's talk about the bond market a little bit more, because like you said, you were looking for rates to stabilize. Is a 30 basis point or so drop in the 10-year yield in a week stabilization, or does that volatility, even though it's a rally, make you a little bit nervous?
No, it's a fair point. And again, a 6% rally and a 7 or 8% in some other areas of the market is a lot. And the yields have moved so much. I mean, you have the volatility of the stock market. So, I think in some ways you can argue that the move up to 5% from 4% was an overshoot, and you're unwinding that pretty quickly. I do suspect, it's not going to be a straight line for the stock market or rates after this big move. So you're around 450 on the 10-year. That's some, short-term support. So I would watch that closely. And then you have a lot more support around 425. So after this big move, I expect, as you mentioned, probably more stability as opposed to this really sharp pullback that we've seen. But I do think you were ripe for a big move, since you really had overshot on a short-term basis moving into this week.
Do you think we're going to see, I guess, a little bit more broadening of the rally, that if we do start to see meaningful upside, more confidence coming in, is that confidence still going to be shuttled into, the 7 or the dozen best stocks out there, or is it going to be a little bit more broad-based?
Yeah, well, when we looked at the kind of how deep the oversold conditions were in the kind of the average stock, the equal weight index and small caps, we thought the relative performance would be there. We've seen that this week, with these areas up about 7%. And we're seeing broadness. Yesterday was a 7-to-1 up day. Today, we're seeing a 6-to-1 up day. So we are seeing the broadening. I think that likely continues. And what's notable is the small caps and the equal weighted index, despite this big move this week, they're flat for the year. And as we move, deeper into this positive seasonal time of November to December, I think these being up areas will continue to perform or outperform, at least on a short-term basis, just given how oversold they became.
Keith, great to talk to you. Have a wonderful weekend, man. Keith Lerner there,
Thank
Chief
you.
Market Strategist and Co-CIO over at Truist Advisory, helping us kick things off to the close. Coming up, a conversation about Maersk, the big shipping company, cutting 10,000 jobs to shield its profitability and what it says is a weakening shipping market. We're going to talk about what it means for the outlook for global trade.
Plus, we'll get insight on this week's global central bank decisions from Dr Rajan. He is professor of finance at the Chicago Booth School of Business.
And an exclusive interview with the most important Bostic in the U.S. economy, Atlanta Fed President Raphael Bostic, sitting down with Michael McKee in just about an hour's time. Stick with us. That's coming up, and so much more on The Close on Bloomberg.
Out of the 10,000 jobs we have announced we're going to reduce our workforce with, 6,500 have already been executed. The rest of it is an acceleration of those cuts that will take place mostly here in the fourth quarter. So we're getting our cost base in order. We're getting fit for what could be leaner times here ahead.
That was the Maersk CEO speaking after the company said that it's cutting at least 10,000 jobs. That's basically to shield its profitability in what it sees as a shipping market that is set to remain weak until about 2020. 2026. For more, let's bring in Lee Klaskow. He is Bloomberg Intelligence senior transportation and logistics analyst. And Lee, digesting the news from this morning, how surprising is it when you think about the shipping industry overall?
I mean, honestly, it's not a huge surprise. I mean, rates are down around 85% from their September 2021 peak. They're down around 70% year over year. Container rates have been in a free fall because A, there's too much supply on the water, and B, there's just not enough demand. And the problem really is, if you look forward, is that the supply growth is expected to outpace demand through 2024 and probably into 2025. So what that tells us is that, we are going to have some weak rates for quite some time. The shipping industry is an industry of booms and busts. Most of the players aren't that disciplined. What I would say is Maersk is one of the more disciplined players in the market. They've taken a strategy a couple of years ago, actually, of deciding they didn't have to be the biggest anymore. And they're really focused on becoming more, getting deeper into the logistics supply chain as it relates to shipping a container from point A to point B, trying to get involved in more of those value-added services.
I'm curious, Lee. It's kind of a two-part question. I mean, the first is when Maersk sort of outlines where it thinks not only its business is going, but where the market is going. Is that just kind of a reversion back to kind of where we were prior to the big boom during the pandemic disruptions, or are we talking about something even deeper than that?
I think it's that plus. I mean, what's happening now is that we are normalizing demand. We're normalizing rates. Like I mentioned earlier, rates are down significantly from their peak in September 2021. But, we are getting back to those pre-pandemic levels. And truth be told, those weren't great times for the shipping industry. They weren't making a lot of money. And Maersk probably won't make much money if you're looking at it from an EBIT or from an EBIT standpoint, for most of next year.
Well, that gets to the second part of my question, Lee, which is also the idea as to whether the forecast that they're giving, the outlook they're giving, is actually not severe enough. I mean, we've heard from some sell-side analysts on the street prior to this that we're actually predicting at least industry-wide drops that were actually more severe than what Maersk is talking about.
Yeah, I really think it depends on what's going on with, obviously, global trade. Right now, in my very foggy and cracked crystal ball, there really aren't too many catalysts that should drive a huge increase in demand. Demand next year might increase low single digits. The year from that, low single digits. But there's probably more risk to the downside. And if you have more downside risk, people aren't stopping, $100 million ship order. When that ship hits the water, they want to put it to use because they have a loan on that ship and they need to pay interest expenses and payments. So, they're going to put that ship out, and that's going to, again, continue to create slack capacity within the marketplace and weigh on rates in the foreseeable future.
Lee, would you expect to see some of Maersk's competitors take similar actions if this truly is an industry-wide story?
It really depends on, the individual companies. A lot of these companies are kind of propped up by the sovereign governments in which they reside, especially some of the Asian players. You probably could see it more in the non-Asian domiciled players. You could see similar moves. At the end of the day, they're just right-sizing their organization. They probably hired too much when things were good because they couldn't get enough bodies in the door, and they're just trying to correct for that.
All right, Lee, really appreciate the insight. Our thanks to Lee Klaskow of Bloomberg Intelligence. And Romain, I mean, of course, there's different nuances between every industry, but you look from tech to shipping, and it just seems rough. Yeah,
it seems rough, and that's why I was curious about whether this is just kind of that reversion to the mean, because we know the pandemic just kind of upended everything, right? In a good way for a lot of these companies. But so it was like, are we just going back to what would have been normal, say, prior to 2020, or is this really a downturn? And at least based on what we're hearing out of Lee and some of the other folks, sounds like this is going to be worse.
Yeah, and it remains to be seen, again, as Lee said, whether we see some of the peers take similar actions to Maersk. But
have you tried? Have you ever shipped anything by shipping container before?
No. I grew up in New Jersey. I moved to New York, so I've never really gone far.
Okay, so what was that? Just like a U-Haul or something to get from there? Okay, you can't take those to the tunnel. You have to go over the bridge.
No, I always go over the bridge.
Yeah. Okay. All right. Well, we'll be back in a moment with more discussions about Katie Greifeld's travels. This is Bloomberg. This is the countdown to the close, almost 2:30 here in New York, with stocks staging yet another day of gains, setting up for one of the strongest weeks for equities that we've seen all year. It's a little bit of a different picture right now in the commodity space. Let's get to Abigail Doolittle, who's standing by right now with our commodities close. Abigail.
It really is a different picture. Divergence between these risk assets. The Bloomberg Commodity Index on the day up ever so slightly, really weighing on it. New York crude oil down 2.3%, having to do with demand concerns around China and the weakness in that economy, perhaps the global economy, although we're certainly not seeing signs of that here in the U.S. And also as the Israel-Hamas war is perhaps contained right now, causing traders to send oil down. Technically also a bit broken, as we've talked about over the last couple of weeks. Heating oil futures down 3.4% yesterday, higher, so maybe a little bit of a reversal of that, especially as weather gets just a little warmer here in New York, which we'll take. And then overall, though, the story is commodities should be sharply higher, and most of them are. The Bloomberg Dollar Index down quite a bit on the week, down more than 1%, the worst week since July. That's helping out most commodities except for the energy complex. As for the Bloomberg Commodity Index overall, on the week, this is pretty interesting. It is down. It is down for a second week, so that divergence with stocks really in play. Stocks are very much contained by resistance. The commodity index looks similar, where this is a strong level of selling power. It tells you the sellers are stronger than the buyers only because there's lower highs. The buyers are not willing to step up. It's going to be interesting to see, Romaine, which way this goes. If folks see this as non-inflationary, it could help stocks, or risk assets quite often trade in the same direction.
All right, our thanks there to Abigail with a closer look at what's going on in the commodity space. Meanwhile, let's go back to what is shaping up to be one of the biggest corporate and financial stories that we've had in years. Sam Bankman-Fried found guilty on all 7 charges of fraud and conspiracy. It was a 4-month-long trial, and it took just a little over 4 hours for jurors to deliberate and render their verdict. The judge has now set sentencing for March, and Manhattan U.S. Attorney Damian Williams, he had something to say about the decision. Take a listen.
This case moved at lightning speed. That was not a coincidence, that was a choice. And it's also a message. It's a warning, this case, to every single fraudster out there.
And the lead prosecutor there, speaking a little bit earlier to the press. Joining us right now is Robert Frenchman. He's a partner, a lawyer over at McCasey and Frenchman, to talk a little bit more about this verdict. And Robert, let's start off here with the speed that the jury did come back, because I think that took a lot of people by surprise, given just how lengthy this trial was here. Was that a reflection of just how strong the government's case was, or a reflection of how weak the defense was?
It was. Thanks so much for having me on. It was an unusually swift verdict. 4.5 hours after weeks of testimony is very quick. Not only that, the case was investigated and prosecuted very swiftly, a year from the collapse of FTX. So it's a clear and decisive verdict. On top of that, it was unequivocal, right? There were no acquittals. It was a clean sheet.
Right.
And I think a clear message to the crypto world: this will not be tolerated.
I am curious about Sam Bankman-Fried making the decision to take the stand in his own defense. And there are some people have interpreted that as kind of the Hail Mary, that after that weeks of prosecution laying out their evidence here, that his only hope for an acquittal was to tell his own story.
I certainly agree with that, Romaine. Testifying in your own defense is always tough, and it's always risky, especially true when you have to do it from a jail cell in Brooklyn. And I think that was a very consequential decision by Judge Kaplan. Anytime you testify in a case like this, you have to be ultra prepared. You have to know exactly what you're going to say on direct. You have to practice doing questions on cross. Very tough from MDC in Brooklyn. On top of that, as you probably know, he made a lot of public statements including public statements after his indictment.
Yeah.
Many of them were self-critical. Many of them were critical of regulators. Many of them were inconsistent with his defense.
Yeah.
So it's...
And just to be clear, I mean,
Yeah.
Katie, I'm no lawyer, but usually lawyers generally prefer that their clients actually keep their mouths shut.
Yeah,
during that time.
I think so.
Yeah.
I think that's a standard practice. But, you know, given the unideal circumstances for preparing for his own testimony on net, do you think that helped or hurt his case?
I think on balance it was a negative. I understand why he did it, and I think he felt he needed to after the three cooperators, but it really was an uphill battle from the start, and both of you are right. Most lawyers advise against making public statements post-indictment.
And given that he did make public statements, that he ended up having to return to jail and you know, just putting it all together, obviously a lot of focus right now on sentencing. I believe that date has been set for March. What should we be anticipating in terms of a sentence, perhaps, given that a lot of these charges, the most serious of them, carry sentences of more than 20 years apiece?
It rests with the judge in a federal case, and you know he's got multiple felony convictions. He's going to have a loss amount that's very high, and other things that will work against him. You know, I think Judge Kaplan will be fair. He's permitted to consider the totality of factors and circumstances, essentially SBF's whole life. And I think he'll do it in a thoughtful and careful way, especially an experienced judge like Judge Kaplan.
Well, Robert, it's really great to get your insight. Appreciate you coming down. Our thanks to Robert Frenchman, partner at Mukasey Frenchman. Now, Sam Bankman-Fried isn't the only one facing legal trouble. Yesterday, the FTC released a less redacted version of its antitrust complaint against Amazon, alleging that the big tech giant doubled the number of junk ads to boost profits and deleted internal communications to thwart a federal antitrust probe. FTC Chair Lina Khan spoke to Bloomberg's Emily Chang at a tech and antitrust event in San Francisco. Let's take a listen.
Really interesting is how, be it in this case or a whole bunch of other cases relating to platforms, we see like a monopoly playbook. And so in the early years, the firms are chasing growth and share, and so they'll actually compete to make their products good for people. But we've seen how in digital markets, once the market tips and these firms start enjoying monopoly power and are able to start protecting that power, we see that they start, you know, becoming too big to care in a basic way, where they can kind of make their product worse, they can make it more expensive. Cory Doctorow has written about this really effectively, about the kind of life cycle that we see where at the kind of end stage of the monopoly cycle, these firms are just in extraction mode, where they're really not having to compete or make their products better. And sometimes it can be hard to kind of imagine what the counterfactual would be, right? Like what would have happened if we'd had more competition. But what's so interesting that we were able to find through our investigation was that, you know, you don't have to, they weren't being subtle about it, right? These were tactics that very overtly had the effect of overcharging people by upwards of $1 billion, actively degrading their services in ways that they recognized was making the product worse. And at various points, you know, there were folks at Amazon saying, hey, like, we think these practices are actually bad for people. Let's not do it. And at each juncture, they were overturned by the executive. So it's, you know, all laid out in our lawsuit. And, you know, we think we have a strong case.
So in your view, Amazon is a monopoly?
Yes, that's what our lawsuit alleges.
And that was FTC Chair Lina Khan in conversation with Bloomberg's Emily Chang. Now, still head on the close. The downgrades just keep on coming for Estee Lauder. We'll ask analyst Dana Telsey the factors fueling her downgrade in top calls next. This is the close on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analysts at recommendations. And we're going to start off here with Six Flags, getting an upgrade today to buy. This over at Citi with the analysts pretty excited out there right now about the potential sale of the company to theme park competitor Cedar Fair. The parks owned by each company already had a solid 2023 season, according to the analysts, and he says combining forces should add significant additional value. Those shares adding value today having their best day since May. Next up, Apple supplier Skyworks. A number of Wall Street analysts either cutting their price targets or recommendations for Skyworks, which gets more than half of its revenue from Apple. Weak guidance leading Summit Insights to downgrade to hold from buy, saying there just aren't enough catalysts out there to drive growth in 2024. Nevertheless, Skyworks, which opened lower by 4% higher on the day. And finally, Estee Lauder hit with its third downgrade this week. Berenberg cutting its rating to hold from buy and slashing its price target to 118 from 224. The analyst concerned by a decline in market share trends, particularly in mainland China, and he also sees a lot of risk out there from business disruptions in Israel and other parts of the Middle East. Shares of Estee Lauder down 3% on the day and now heading for their worst week going back to May. I do want to say on Estee Lauder right now, because earlier this week we did get a downgrade from Telsey Advisory Group. They actually raised some concerns here after the company released its report, some concerns here about the trends moving forward. Dana Telsey joining us right now, the founder and CEO of Telsey Advisory Group, to talk a little bit more about this. And Dana, I am curious here about exactly what's been driving this weakness. I know there's been a lot of talk about Estee Lauder's presence in duty-free shops and airports, and how if we're not all traveling, at least not at the same level that we were a couple of years ago, that they hurt. Is that really a material issue for them?
I think the real material issue for us and the change is the fact that when you look at Asia travel retail and China, the return to pre-pandemic levels, particularly on travel retail, may not occur. It had been up to 27% of sales. It fell to 19% of sales and is going lower. It's a very high margin business. And when you have nearly 40% of your business coming from China and Asia travel retail in total, and it may not return to pre-pandemic levels, that impacts in our mind the growth algorithm and what the margins could become. So that reset with the 9 to 9.5% operating margin this year, when in previous years it had been 16, 17, even 18%, it's not just the hockey stick return to growth from easy comparisons that can help you revive. So that longer dynamic is what made us adjust our rating.
I am curious. I mean, obviously they get a lot of their revenue, like at least a third, I think, from Asia Pacific region overall here. Is there any hope that their presence in other regions, primarily here in the U.S. and the broader Americas, can make up at least for some of that drop?
We're seeing some improvement in the U.S. That is encouraging. The U.S. returned to growth this quarter. An acceleration of innovation on the product side is underway. The fact that even the MAC brand in makeup, globally, it showed increases in makeup and in skincare is encouraging. But you still need to make up for this Asia weakness that will take time. So I'm anxious to see, as they progress, what that path looks like.
So you do note that, of course, there is a return to growth in Americas. That's encouraging. Is there any hope that Americas and those other regions that Romain mentioned could eventually offset what we're seeing in China, or is the disparity too great?
Right now, the disparity is too great. Yes, we're going to go up against easier comparisons when we get to the first half of calendar 2024. But those easier comparisons, you also need the Americas to continue to see accelerating growth, so we drive those sales increases and drive profit margins. Estee Lauder is a company with wonderful brands. We know that the beauty category continues to be solid. You have a changing dynamic with the potentially overexposure to Asia retail, travel retail is what's leading to this prolonged period of weakness in the margins. Let's see it progress and see that path go forward.
And let's talk a little bit about what's been going on in the shares this year. Obviously, you just downgraded the company to market perform, but you take a look at shares down 55% so far in 2023. I mean, how bad is sentiment on this stock, and is that warranted?
Keep in mind that you've had a company that typically has not only met expectations, but beat expectations. You had a wonderful year coming out of COVID. The reset that's happening both in SKU rationalization, Asia travel retail, has been a real impact. I think you're having a change in shareholder base, given the fact that you've had this level of share price depreciation. And now the ability to meet and beat, that needs to come to the forefront again. And I think the confidence in the game plan, I think that's what's showing in the share weakness currently.
All right, Dana, it's always great to talk to you. Really appreciate your time on this Friday. Our thanks to Dana Telsey over at the Telsey Advisory Group. Much more ahead. This is The Close on Bloomberg.
A big week for central bank decisions. The Fed here in the U.S., the Bank of England, the Bank of Japan, and one of the big takeaways that investors had, well, is that maybe that global rate hiking cycle may finally be coming to an end. But now attention turns to another big issue, and that is the potential increase in regulation of our banking systems globally. To get an insight into what's going on, let's bring in Dr Rajan, professor of finance at the Chicago Booth School, former governor of the Reserve Bank of India, and former chief economist at the IMF. Dr. Rajan, great to have you here on the program. And I do want to start off with some of the, I guess, wisp of regulation going on out there, particularly coming off of the regional banking crisis in the U.S., where folks now say the capital requirements maybe need to be lifted. They're also, just today, about an hour ago, we got news out of Janet Yellen and some of the folks on the Financial Stability Committee that they're now looking to expand the umbrella of what constitutes too big to fail. Do you think now is the appropriate time to consider these types of changes?
Well, I think it's always good to take a look at your regulations. It's not always good to keep changing them, but it's important to see that they're fit for purpose. My worry a little bit is that whenever we run out of ideas, we say, let's add more capital to banking capital requirements. And we sort of think the system will become safer. Well, we have to remember that there's a reason why banks try to economize on capital. They find it a high cost of financing. And while some reasonable capital requirements obviously make sense, they were too low during the global financial crisis, I think we have to be careful about increasing them so much that banks don't do what they're supposed to do, which is take some amount of lending risk and expand economic growth. And I think, when you look at the large banks, they seem to be reasonably well capitalized. So we have to worry about whether keeping on adding capital requirements for them is the right thing to do.
Well, I'm curious because we've heard some pushback from some of the big bank CEOs. Obviously, Jamie Dimon, as always, is usually one of the more vocal critics of some of these issues. But as we speak, you have this FSOC meeting adjourning. And it's interesting, the readout from it is that all the main regulators, at least here in the U.S. of the financial system here, seem to be on the same page. Now, we know the details of it are going to take a long time to be sorted out, but they all seem to be singing from the same hymnal.
I think they are, but you have to understand that we've had a pretty big regulatory failure earlier this year, right, in March. And, we have to look into what exactly happened there. And I would argue that what we saw happening there is not really a failure of capital. It wasn't that they had too little capital, but given their capital, they did the wrong kinds of things at Silicon Valley Bank, for example. And, it was as much a failure of supervision, of Supervision 101, making sure the banks don't take undue duration risk, for example. That's not going to be solved by more capital. It is going to be solved by cleverer supervision and regulation. So we have to be careful of overemphasizing one tool while underemphasizing other tools. We need balanced regulation, not extreme regulation of one kind or the other.
Well, we'll see whether this current push, what it actually materializes in. But I'd love to get your thoughts on what we've seen this past week from the global central banking community, because it wasn't just the Fed. Of course, we had the Bank of Japan, the Bank of England. And it seems like, especially if you look at what's playing out in markets right now, that really markets have settled on this idea that we're at peak rates around the globe. Is that your sense as well?
I don't think the central banks are confident yet. And so I think the markets are anticipating what the central banks will do rather than actually, getting into their minds. I think we've seen some reasonable slowing happening. Of course, today's labor market data suggests, broadly there is slowing, but of course the unanticipated lower numbers are probably due to the strikes that we saw this month. That said, the economy is slowing. But not all news is going the same way. We've seen core inflation pick up over the last couple of months in the U.S. So I would say that, at this point, Chairman Powell is cautious. He wants to believe it's going in the right direction, but he knows it can turn around quite quickly with new data as they come. So, when central banks don't know what is going to happen, they say they are data contingent. And I think all the central banks are data contingent. They haven't declared a pause yet. And I don't think they will be prepared to do that. One of Chairman Powell's biggest worries, of course, is setting off a financial market spree when, in fact, he needs financial conditions to tighten. So what happened over the last couple of days is certainly not to the Fed's liking in terms of market movements.
Yeah, those financial conditions, a little bit of a fickle friend. And we don't have a ton of time left, but you mentioned that we're getting different pieces of information from different economic data points. And we think about this recession that people have been calling for. Do you see the U.S. entering a dynamic where it's a rolling recession, potentially hitting different parts of the economy at different times?
It could well be, but any attempt at forecasting over the last year and a half has been a miserable failure. That said, there's no reason why we wouldn't have a quote-unquote normal recession in the sense that we do slow, and we slow more than the Fed intends, partly because, some of the factors holding up labor markets, for example, labor holding corporations are holding on to their workers, that may fall off. Once corporations see it's relatively easy to hire, there's some labor market slack, and then you could see more firing just because people know that they can hire, sometime down the line. So my sense is these things never proceed in a linear way. They don't proceed as softly as the Fed intends. We may get more slowing than it intends. Does that mean a deep recession? Not necessarily, but it does mean some slowing over the next year.
All right, Dr. Rajan, I'm going to have to leave it there. Always great to talk to you. Raghuram Rajan, professor of finance at the Chicago Booth School and former Bank of India governor here. As we round out into the final hour of trading here on The Close, you definitely want to stick around. We have an exclusive interview coming up with the Atlanta Fed President, Raphael Bostic. That'll air at about 3:30 p.m. New York time, right here on Bloomberg Television. Stick with us. This is The Close. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostic.
And I'm Katie Greifeld.
The fastest hour on television begins right now with a look at equities right now. Katie Greifeld, and there are going to be a lot of superlatives today. You talk about the S&P on its longest win streak since mid-June here. And I just took a look at this. The Russell 2000 on a weekly basis, setting up for its best week since April of 2020.
It is pretty amazing how quickly some of these narratives can change, especially you think about small caps. It was hard to find someone to even talk about them. Everyone hated them so much. And here we are. This rally has been big and it has been broad.
Yeah, you take a look at that 10-year yield on the day, down 10 basis points on the week. The biggest drop that we've seen in those yields on a weekly basis going back to November of last year. Another drop that we're seeing in crude oil prices on the day and on the week. And look at some of the rate-sensitive sectors here. Utilities higher, and so too are a lot of real estate companies. Bloomberg REITs index up 3%.
All it took was a 30 basis point drop in 10-year yields over the course of 5 days, and there you go.
Well, don't worry. Given the way the bond market's been reacting, we'll probably get a 30 basis point rise in a week or two as well here.
Exactly.
Flip up the board real quick, because I just wanted to take a quick look here at corporate credit, because there's been a lot of discussions about when we were going to finally start to see that credit risk emerge. And we should point out, at least on a daily basis, we're starting to see that credit risk go down. This is an investment grade index here, the market CDX index, now on a 5-day drop, which suggests an improvement in credit risk here. But even if you look at junk bonds, it's the same thing here. People just aren't shook right now in that space.
Exactly. I mean, that's been the story at these risk gauges. Of course, also when you look at spreads all year, has been hard to budge them. But let's talk about some of the individual movers today, because it's also earnings season, and we have a lot of earnings stories to get to. I want to talk about DraftKings.
Gambling.
A lot of people, apparently, because they had strong user engagement. If you take a look at their monthly unique players, their losses narrowed as well. They also boosted their guidance. So you add it together, shares are up about 16% 1% year to date. Wall Street, the sell side, absolutely psyched as well. So
I think the stock that I'm most interested in was the second one you had in your screen, which is the company formerly known as Square.
yeah, we're talking. The ticker still indicates that it should be named Square.
Yeah,
but
are they going to ever change it? This is sort of like Elon Musk with Twitter X, where it's called X, but they keep Twitter.com.
Good thing he took that private because
Sure,
it was
no
very
problem.
confusing.
Yeah.
Let's talk about Block. Block also having a good day, up about 12%. It boosted its profit outlook. People love Cash App. I don't use Cash, but customers increasingly turning to it. So you look at what that means for adjusted profit. Block saying it's going to be pretty good. And let's quickly talk about Weight Watchers, the company formerly known as
WW. That's also a formerly known as company.
I know. A lot of difficult names here to remember. Not a great earnings story here. So net revenue for the third quarter below consensus. It also sees full year revenue at the low end of its previous range. Shares down 9%.
9%. Wow.
Yeah.
All right. A lot to cover here. Some of the big individual movers there on a day where the markets are having a very good day here. Adjusting to what's going on as we were about an hour away from those closing bells. Our cross-platform coverage. It starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, TV, radio, originals, and that streaming partnership that you love, Carol Massar, with YouTube.
I do. What's not to love? Having said that, interesting rally. Sorry, Apple, that you're not a part of it. Maybe we'll talk about that. What?
I don't know, just a little camera action going on.
Sorry.
There you go. No, you don't move. I think the camera's supposed to move with you.
Looks great now, though.
I'm very centered.
Yeah.
All right, so let's talk about things. Two big economic reports, right, that both indicate some slowness, certainly in the U.S. economy. You guys have been talking about, we've all been talking about, the monthly jobs report showing slow, maybe the labor market finally slowing down. And then you also got to read on the U.S. services sector. We saw that also showing some slowing down as well. We were looking at some different metrics, if you will, in terms of the economy. I think you guys talked about it, too. Maersk, right, the shipping giant, great bellwether for the global economy.
Yeah, do they pronounce
Isn't
it that way?
Maersk?
We've been struggling with it.
Maersk?
Yeah.
Maersk? I don't know.
I think Carol's right.
Maybe
Maersk.
I trust Carol.
Maybe I don't know about that, guys. I was not, centered before, so I don't want to trust me on anything. Anyway, to see them cutting, they've already done a lot, let go a lot of workers, but what, 10,000 of their global workforce? And I thought what was interesting, doing it to shield it from profitability in a shipping market that it says is set to remain weak until about 2026. Remember when everybody did labor hoarding because they were worried about not being able to get workers? It just feels like it's a shift, guys.
Well, speaking of a shift when it comes to shipping, we got to keep an eye on what's going on in the Panama Canal because it does not have enough water again. That's due to a lack of rainfall, climate change. So restrictions already started on how many ships can pass through the Panama Canal. And Romaine, this has serious implications for global trade.
Sorry, I meant not to smile. I was smiling.
I was thinking about the weather and how, I don't know, I love all these real economy stories where you have to worry about the physical earth and how much it's raining and what that means for...
We don't want a repeat of what happened in the Suez Canal with the Evergrande.
I mean, I got a lot of good Twitter content out of that, but go on.
But the limiting of the shipments is until February at least.
And what happens if the ships have to take an extra week to get to their destination? What does that mean for global trade?
More fuel, higher costs.
Yeah.
Wow.
They're
very, very Debbie Downers today.
Sorry.
With Tim and Carol there. I was thinking about, the little things in life that, makes us happy.
All right, guys. Take it away.
It is Friday.
Little luxuries,
glass
if
half
you'll
empty,
have them.
Glass half full. We give
I don't know if you guys are doing this, but apparently a lot of Americans are basically dialing back purchases of big ticket, pricey items, and like boats and fridges. I like that boats and fridges were put on the same pedestal in this story.
This week?
I feel like one is a necessity and the other is like, not.
Well, you need a fridge for your boat. But in any case, Americans aren't doing that. Increasingly,
How many
they're turning...
fridges do you think Carol has on her boat?
One, it's really small.
2 per floor.
Very
but
small.
Starbucks, Chipotle, PepsiCo earnings all point to the fact that, consumers are still buying these like $7 lattes to $11 burrito bowls because you need to still have these small luxuries in your day to
That's cute that
keep
you think a
showing up.
Chipotle burrito bowl is only $11.
I was going to say $11 for a burrito bowl sounds like
$7
a real
latte
bargain.
sounds about right. But
That obviously
$11
does not include guacamole.
Yeah. clearly.
Or meat.
Remember they used
or
to
silverware.
they used to talk about like little luxuries that women would buy a lipstick when like there was a recession, right? Because it didn't cost too much.
Wasn't that the old lipstick indicator?
Exactly,
Yeah.
exactly. So it feels like a kind of a iteration, if you will, of that.
It is interesting to see it because we talk about the U.S. consumer all the time, and you're getting mixed signals from different sorts of reports and the typical staples. I mean, you think about a $7 latte, that's not a staple, but people are clearly still willing to spend on it, myself included, but that's kind of in any economy.
If you buy enough of those, Katie, you can, save up to buy a boat.
If I buy enough of them, will the Fed have to hike rates in December?
Yes.
I don't know.
A boat or a fridge, because
Yeah.
that seems to be the choice.
Yeah.
All right, guys, we're going to be back in less than an hour's time. Going to wrap up the day and, of course, the trading week. First trading week, not full week of November, but nonetheless, November off and running. We're going to join you cross-platform, radio, TV, YouTube, and Bloomberg Originals. We will see you at 4 p.m. Wall Street time.
Continuing our coverage right here on the close, counting you down to those bells. A little more than 50 minutes to go, and all the talk today is about legendary investor Stan Druckenmiller telling Bloomberg that the Treasury here in the U.S. is getting hit by rising rates, saying, look at that contrast with what U.S. households did. Basically, he's talking about the average maturity of mortgages, saying how they went from 3.5 to 8 years. That's a good thing here, but his question is, well, was this a response to why we haven't seen the economy tank? Consumers and corporates, when rates were zero, they turned out all their debt. They're not getting hit with all that interest rate increase now, but the Treasury is, and the Treasury is for the next 10 years. Basically making the broader point here that the Treasury had, well, several years of near zero interest rates where they could have borrowed to the hilt, and he says they should have borrowed a little bit more. Carissa McDonough joining us right now, Senior Vice President and Fixed Income Strategist over at Nottingham Trust, a division of Community Bank. And Carissa, I do want to start there here because, Druckenmiller, he's been talking about his big trade, which is relatively bullish on Treasury prices. The idea here, what we're going to start to see out there here would actually work to his advantage, assuming that he still holds that position. I am curious as to where you think the direction of prices and that for matter rates go, and whether there is a direct link with what the Treasury has to do, which is issue more debt at higher rates.
Excellent question. Thanks so much. We definitely think that the sell-off that we've had in treasuries is closer to the end than the beginning. We definitely had a significant reversal, say, over the last 2 weeks with 50 basis points of rate change. But when we see these periods of extreme volatility in treasury prices, that's really the Treasury trying to find its level. And that's Treasury rates. You've had price-insensitive buyers backing away between the Fed running off its balance sheet. You've had banks lessening their holdings, China backing away. So again, we're near an inflection point. So our outlook is, we may still have periods of volatility, but we do think that rates, the general direction of rates, is down. So our thesis is, yes, this is an excellent time to be extending your Treasury maturities in your portfolio.
Well, I'm curious as to which one of those elements sort of dominates that move down. Is this about Treasury supply? Is this about the Fed pausing and maybe even cutting? Or is this more about economic conditions and whether they're deteriorating?
Definitely a mix of the three, but if I had to pick one, I think it's the third. I think that economic conditions, they are going to deteriorate, and we've already started to see that. We had a whole slew of weak labor data this week. And let's not forget, you showed the corporate credit index earlier. We actually think that, you're starting to see distressed debt on the rise. You're starting to see, problematic access to capital markets for a lot of borrowers. So we think the economy part is what's really going to be driving yields down longer term. I think the Treasury kind of price-insensitive buyers, that has been felt and kind of moved through. That has been priced in already.
Okay, so that story priced in, but you talk about maybe a potential for yields to drop from here. Of course, we got up to 5%, we got below 4.5%. Where do you think fair value is, roughly speaking?
We think that we're pretty close to it at this point. Would say between 4 and 4.5%. You can certainly have moves on either side, and it was a very fast move up to 5%. But again, if this overarching story is that the economy is starting to slow, it's going to be very hard for yields to continue to move up. And I will note it was such a fast move. down, that we will have some time to kind of digest that. But this remains a great time to extend maturities. You're talking about another 50 basis point move possibly in long yields down. That's another, 5% return and close to 10% if we're getting below 4%. So these are real numbers, like excellent return potential, and we do think that the bias is down.
And Carissa, when we think about the yield curve in totality, you're seeing a ton of money being poured at the front end. If you take a look at money market funds, you take a look at ultra short duration ETFs, a ton of money coming into the long end as well, viewed through ETFs. What is the logic for going into the intermediate part of the curve, into the belly? Does that look attractive too, or is most of your opportunity going to be either at the front or the long end?
Oh, we actually think that the long end remains a little more favorable. The interesting part is if you look at implied forward rates for like the intermediate part of the curve, those don't look like they're going to move very substantially, at least according to futures, for the next couple of years. So if you're looking for like kind of a stable coupon clipping investment that, without the total return potential, that's a reasonable place to go. But we're very strongly in favor of the longer duration you can go, the better.
And bring that logic to the rest of the fixed income market. Outside of treasuries, when you take a look at high yield, when you take a look at blue chip bonds, where is the most opportunity right now?
Excellent question. Again, starting with high quality and, like long maturities. This is not necessarily what we've said before, but we think, the systemically important banks continue to be a solid place. We could get concerned to a degree about the less well-capitalized or the non-SIFI banks. And again, the structure of the high yield market has been such that there's not been a lot of new issuance there. A lot of the lending has taken place in private credit. So if we're concerned about a bubble or about distress, that's actually where we think it's going to occur. We don't necessarily think it's going to happen directly in corporate credit, kind of as a follow-on. And that's back to the whole discussion of, what causes a recession. It would be a financial accident someplace. And we think that that could be the start in that area.
All right, Carissa, really appreciate your time on this Friday. Our thanks to Carissa McDonough, Senior Vice President and Fixed Income Strategist over at Nottingham Trust. Now, coming up on the half hour, we'll have an exclusive interview with Atlanta Fed President Raphael Bostic, get his take on the U.S. jobs report, inflation, and the future path of interest rates.
And a focus on crypto with a sit-down interview with MicroStrategy Executive Chairman Michael Saylor as that company reports its latest results.
And we'll speak with Bob Diamond, founding partner and CEO at Atlas Merchant Capital, and get his reaction on the latest Fed announcement and the global banking outlook. All that and more coming up. This is The Close on Bloomberg. Well, this week, MicroStrategy reported third quarter results beating gross profit and revenue estimates, and it aims, of course, to buy more Bitcoin. It continues to be the largest publicly traded holder of the cryptocurrency. And joining us now, I'm thrilled to say we have MicroStrategy Executive Chairman Michael Saylor. And Michael, I do want to get to the earnings reports, but we got to get to the crypto story of the day. And of course, the financial news story of the day. And that is finally a verdict in the Sam Bankman-Fried FTX case, being found guilty on 7 counts of fraud. We'd love to hear your reaction to that ruling and what it potentially means for the crypto industry going forward.
I think it's an important milestone in the growth and the maturation of the industry. The crypto industry has been plagued by inexperienced entrepreneurs like Sam, unreliable custodians like FTX, incompetent creditors, a dozen went bankrupt in the last year or two, unscrupulous promoters, and their failure is a necessary rite of passage for an industry that's going to lead to a new, more stable, more scalable ecosystem that'll be based on Bitcoin. Public companies like Block, MicroStrategy, Marathon, a dozen Bitcoin miners that are public, institutional money managers like Fidelity and BlackRock, and regulated banks when they eventually become custodians. The offshore crypto exchanges, the stable coins, the crypto tokens, the DeFi projects, they're going to shrink, fade into the background, and decouple from mainstream and institutional digital assets marketplace that'll be based on Bitcoin.
And Michael, you bring up BlackRock, you bring up Fidelity, and of course, both of those firms have applications in for a spot U.S. Bitcoin ETF, something that hasn't been approved yet, but there's a lot of speculation, a lot of optimism that it could be soon. What would that mean for MicroStrategy, given that, I mean, you've been on the record, too, saying that MicroStrategy shares are a proxy for Bitcoin. If you're able to get that through a physically backed ETF, would that lessen the premium that MicroStrategy enjoys?
I think it's critical for there to be a spot ETF for mainstream retail investors and mainstream institutional investors to participate. So it's going to lay a base layer that's going to allow large amounts of capital to flow into the industry. MicroStrategy is a special investment vehicle for Bitcoin long bulls. We're different from an ETF because we don't charge a fee. We can use intelligent leverage. We borrowed $2.2 billion at 1.6% interest to buy Bitcoin. And we can generate a tax-deferred Bitcoin premium either by using cash purchases or by capital markets activity. So we're not for everybody, and in sovereign wealth funds that want to buy $50 billion worth of Bitcoin can't fit into the MicroStrategy capital structure. But if you want leverage and this tax-deferred yield and no fee, then we're an interesting alternative for people in the space.
With regards, though, to building up that position, that crypto position even further than what you have, does the introduction of those ETFs, would that create competition to increase asset sizes, excuse me?
I think it's going to help everybody in the space. They're going to accelerate education efforts and adoption. Already you can see Fidelity analysts are making a huge impact on the digital asset space. So as you see Wall Street analysts from all these ETF firms and you see their education and marketing efforts come into the space, and as they provide the rails for traditional institutional investors and endowments and the like to engage, they're going to expand the entire ecosystem. But they're not an operating company. They can't take on leverage. They can't not charge a fee. I mean, we literally don't charge a fee. And they can't engage in cash purchases with operating income like we can in order to generate that tax-deferred Bitcoin premium.
It's interesting, too, to see some of the moves in Bitcoin this year. Obviously, the volatility is still there, but not necessarily to the extremes that we saw in prior years. And I'm wondering if the introduction or the broadening out of the user base will reintroduce that volatility, or have we kind of moved past that? Are we kind of in a different era now?
Well, I think we've reached a nice point, but you know, when Bitcoin passed $100,000 to $200,000, maybe it'll trade from $250,000 down to $175,000, and people are going to be screaming the end again. Bitcoin is compounding at 40 to 50% annualized growth rate for the past 3.25 years since MicroStrategy got into the space, with a lot of volatility. I think an analyst, Timmer from Fidelity, pointed out it is got the highest volatility of any asset, but it's also got the greatest return. And so, as I've said in the past, volatility is vitality. I'd rather have the volatility and the performance than get rid of the volatility. Gold's not volatile, but it's also down 1% in 3.25 years. So that's not what we're looking for.
Well, Michael, I want to talk a little bit more about the user base of crypto. Who's actually buying? Because, of course, if you take a look at the trading market, you've seen trading volume absolutely fall off a cliff. And the narrative I keep hearing is that you've had all these retail players flushed out after what we saw with FTX a year ago. So maybe a spot Bitcoin ETF is in the offing, but do you think that that would actually bring back in those marginal buyers, those retail players, or have they been burned too badly?
Yeah, I think that during this crypto meltdown, the crypto bros offshore and the leveraged hedge funds, they exited the space. They were all bankrupted for the most part. Right now, the natural buyers in the space are Bitcoin hodlers, the maximalists, the people that are sweeping their incremental cash flows into Bitcoin. It's almost impossible, very difficult for mainstream investors and mainstream retail to buy Bitcoin because there are just very few on-ramps. So the natural sellers are the miners, the natural buyers are the hodlers. The trading volume has diminished quite a bit. This is the lull before the storm. Once we get these ETFs in place, that will open up the gateway for mainstream retail and mainstream institutional capital to flow. And the halving in April is going to cut the available supply in half, and it's going to eliminate half of the natural selling. So this next 4-month period is very pivotal to the asset class.
I want to talk about your own Bitcoin holdings, and I have a very detailed question for you. I have to give credit to Tom Quintiliano in our newsroom for this. If you take a look at page 21 of the latest 10Q, it mentions that MicroStrategy could raise just over $600 million in an ATM equity offering. Is that something you're thinking about tapping? You take a look at the shares right now, they're up over 200% year to date. Could you use that to add more to your Bitcoin funds here?
We have raised more than $1 billion in the past via ATM offerings, and whenever we did it, it was accretive to our shareholders. This $600 million vehicle will allow us to engage in more capital markets activity. As we're selling stock at a premium and then buying the underlying Bitcoin, we're capturing a tax-deferred Bitcoin premium for our common stock shareholders. So we're very thoughtful about when we do that and how we do that. And sometimes we'll do it, sometimes we won't. It depends on market conditions and, and where everything trades.
All right, Michael, it's always great to catch up with you. Really appreciate your time on this Friday after earnings. That is Michael Saylor, MicroStrategy Executive Chairman. And it's really interesting, Romain, because we talk about Bitcoin, then you think about some of these crypto-linked stocks. To see a 220% year-to-date rally in MicroStrategy, I mean, it's pretty breathtaking.
Yeah, it's interesting, too. I mean, even just the rally that you see just in the crypto assets themselves. But it raises the question, too. Obviously, we're still a long way from 60+ thousand or wherever we were.
69,000.
How can I forget 69? But we talk about this idea of sort of these grand predictions of where it can go here. And I wonder, does it need broader adoption to get there? Or can it still kind of do that as being kind of a niche investment?
Maybe it needs those speculative traders again, many of which have been flushed out.
One day when you have Michael Saylor on, can you ask him about his boat, the model boat
when he was
connection?
talking about the storm coming, I wanted to say,
I know.
Good thing you have.
I know, because when I was a kid, I used to always want one of those. My mother just refused to get me one for some reason. I have no idea why. But
got to ask Michael next time.
Yeah, okay. All right, don't go anywhere. Coming up here, another exclusive interview coming up this time with the head of the Atlanta Federal Reserve, Raphael Bostic, going to be speaking after the break. This is The Close on Bloomberg. This is the countdown to the close. Just about 30 minutes left to go here, Katie, in the trading day.
And it is another happy day on Wall Street. Take a look at the S&P 500 right now, up about 1% or so. We have 10 of 11 sectors in the green right now. Leading the way is real estate, up by 2.8%. Materials also up by 2%. The lone loser in the group is the energy sector. Energy off by about 1%, Romain, but other than that, it's smooth sailing.
Yeah, we talk about some of the individual movers here and there. You take a look there. Apple shares down about 0.8%. We should point out it was on a 4-day run heading into those earnings here, so still holding on to some pretty significant gains on a weekly basis, but concerns here about the longer-term trajectory for this company, particularly if China turns out to be that soft spot that everybody seems to think it is. Look at Church & Dwight here. Of course, this is a big consumer staples company, and they gave some guidance here that, well, it was their old guidance, and there was a lot of concern as to why they didn't raise their guidance. And they talked, Katie, a lot of this about this idea of an increased marketing spend, which I assume means that they feel like they have to advertise more and maybe offer more promotions to get people to buy some of those products.
And it just, again, speaks to this very punishing earnings season that we're in, where it needs to be a beat and a raise. You need to surpass expectations. Otherwise, you end up with a 7% downdraft.
Well, let's take a look at two quick other ones. Cybersecurity company Fortinet having its worst day in quite some time. That was on the back of a very disappointing disappointing earnings report. And then you have Expedia having one of its best days in quite some time, up almost 20% here. A lot of concerns here that the travel sector really was starting to deteriorate, a sign maybe that that's not necessarily the case. Meanwhile, we want to go down to Atlanta, where our very own Michael McKee is standing by with an exclusive interview with the head of the Atlanta Federal Reserve, Raphael Bostic.
We'd like to welcome everybody to Bloomberg Television and Radio Worldwide. We're happy to be joined by Raphael Bostic, who is the president of the Federal Reserve Bank of Atlanta, which, if you could see over my shoulder, is right over there. Let me thank you for coming into our offices, however, and we thank you for warming it up from yesterday. It was a little chilly.
Well, the pleasure's mine, and welcome to Atlanta.
You were the first on the FOMC to say the economy didn't need any more rate increases. Did the jobs report today basically vindicate your view?
Well, I wouldn't say vindicate. This is a journey, and we're going to be on this journey for a while. What I will say is I'm pleased with the number. It came in at a level that is consistent with what my outlook has been, and it really tells me that our policies are really starting to work through the economy in a way that can help us get to our 2% target for inflation with minimal pain is what I'm hoping for.
Well, what drove the decision on Wednesday to leave rates unchanged? You came into the meeting with inflation up a little bit. The last jobs report was very strong. Consumer spending was very strong, and yet everybody decided to go with the Bostic view and hold. What was behind the thinking there?
Well, I'll tell you what was behind my thinking on this. You know, in addition to looking at the data, I do a lot of on-the-ground intelligence. And in a period that was really unusual for me, everybody was saying the same thing, which is that things are slowing down. We are seeing the economy start to, quote, normalize is a thing that people have been saying relative to this hot pandemic period. When I get unanimity on that, that tells me that there's something that's happening on the ground that is probably stronger than what I might see in the data. And then the data, even though they did come in very strong in September, if you looked over a longer term trend, it still said that the economy was moderating. And those two things together made me very comfortable with the notion that we still have time to watch, be patient, and be cautious and make sure that we understand the trends and don't overreact to any single data point.
Well, barring some exogenous shock, would you say you're basically at the peak now that you don't need to raise rates anymore?
So what I would say is this. There are three possible outcomes. Either inflation is going to stall out in this trajectory, it's going to continue slow and steady, or it's going to go off a cliff. I have all of those possibilities in play, and I'm going to stay on that. Today, my outlook is that we're going to stay on that slow and steady. And if we continue to do that, then I think where we are now will be sufficiently restrictive to get us to the 2% level for inflation. But there's still a lot that's going to happen. And between now and even the next meeting, we're going to get a couple of jobs numbers. We're going to get a couple of readings for inflation. And that'll tell us and give us more signals as to what's going on in the economy.
You mentioned talking to a lot of people in your district who were telling you things are slowing down. Can you characterize that? Because not long ago, the question was, did the Fed go too far? And we're not just slowing, we're going to fall off a cliff, as you mentioned. And others are saying the soft landing narrative. Where do the business people see it?
You know, the business people are in an area of moderation back to normal. They understand that they've gone through a period where they've had sales that are at levels that, frankly, they didn't expect. And the decline in those sales and that activity over time has come in slower than they expected. But it is continuing. And that's really the dynamic that really governs. You know, the thing that I think people need to just keep in mind is that through this pandemic period, through this high inflationary period, we've had exceptional demand. Consumers have been continuing to spend. And once that gets back to a normal level, then we'll be back in a more normal environment where inflation will be at 2%. And so we needed to work through that. And another thing that's been quite interesting is that supply has really responded as well. We've seen labor force participation be much higher than I think I had my outlook for sure. And that's been another moderating force to help us get to where we are today.
A lot of questions about long and variable lags, and maybe they're hitting the economy right now. You guys got the senior loan officer survey this week. Is credit still tightening the way it has been?
Credit is definitely tight, and there is still stuff to happen there. We know that a lot of corporate bonds, for example, they're about to reset. and those resets are going to come in at interest rate levels that are 2 or 3 percentage points higher than they were previously, and that's going to be a drag. I hear the same thing in commercial real estate, where there are a lot of people who are expecting some of these buildings to struggle to hit the valuations that were projected in the previous lower interest rate environment, and that's going to be some disruption as well. So there is still stuff that's going to come from our policy, but I think that ultimately will contribute to us getting ourselves to that 2% level. And right now is really just let the time pass, let's let the economy work through all of this and see where we are at that point.
Well, you and others at the Fed have made the case that now that you're higher, you can go longer, that you'll leave rates at this elevated level for quite some time. You must have modeled out some idea of how long it would take at this level to bring inflation down to the target.
So we have a projection. Like for me, I would say it's going to be in the second half of next year. Of course, that's still 8 months from now, 10 months from now. A lot's going to happen. So I don't try to get too precise and exactly it's going to be this meeting where something happens. But it is still a ways off, and we still have a lot to watch and monitor as we think about understanding how the economy is evolving.
And you think the economy will do fine at this level of interest rates until that time?
So fine is, you know, this very subjective word. I do think we can get to inflation to the levels that are close to our target without seeing a recession. I do not have a recession in my outlook, but I don't also see us growing continuously at 5 and 6%, in the quarterly basis. We're going to be in sort of a slow, steady growth that's methodical. It won't be exciting a lot of folks, but it will be one that sort of doesn't feature a lot of additional pain and disruption for American families.
Chairman Powell has talked about growth needing to be either below trend or potential, depending on the day. We discussed that at his news conference. But do you see that as necessary, that it needs to come down significantly? And do you still believe that unemployment needs to go up significantly in order to bring inflation down?
So I don't know. What I would say is this. There are many states of the world where we can get to inflation to where we need it to be, where we don't see a wholesale and widespread disruption. Part of that is how strong the supply side continues. I saw a report today that suggested that the supply chain disruptions are fully a thing of the past. We might actually be looking for additional supply to be able to fill in. If that happens, then you can get the strong growth, you can get the minimized unemployment, and still see the price level fall, the rate of the price level increase, decline. So that's what I'm hoping for. But of course, I've got to be ready and prepared for any kind of eventuality, and we'll just have to see how it plays out.
Well, the economy growth and especially unemployment have not performed as anticipated by the Fed going forward. So what is it that would get you to change your view of what needs to be done? Is it basically just watching inflation and whether it comes down or starts to go up again?
So to me, there are two things, and I might add a third. But the first is just what's happening with the trajectory of inflation. If it continues to progress towards our 2% target, to me, that's a very positive sign that says, let's let our policies working, let's keep it working. The second thing that I've been looking at from the beginning of the pandemic is inflation expectations. And if we find that consumers or businesses are really starting to feel like that long-term level of inflation that's going to be the baseline is creeping up, if that's their expectation, we've got to act and we've got to take that under control. But that's not what's happening right now. And the long-run expectations have stayed relatively steady throughout the pandemic, and the short-run expectations have fallen significantly. The third one that I'm looking at also is the wage level, and everyone's talking about this. To me, I think that's been a very welcome development in terms of how it's evolved, and that the businesses I talk to are saying we are getting to a place where we're back to our old style. That the 10 and 15% increases in wages that we've had to do the last couple of years, they're not on the table, they're not necessary, and I'm starting to hear more and more. The increase we're going to do this year is very similar to what we were doing in 2018 and 2019, and that's very welcome news.
Well, you said probably see progress on inflation the second half of next year. So at that point, what do you do? Do you start looking at rate cuts?
Well, I would say I'm hoping and expecting to see inflation progress throughout until the next year. And then we'd have to really start to think about, like, what's our long-run neutral level? I think we're in restrictive territory today. And as we get closer and closer to our target, we're going to have to think about moderating the level of our policy stance. But that's down the road. And, it's interesting. I talked to a lot of business people, and they ask, like, how are you thinking about this? For me, if we're restrictive now, we can't wait till we're at exactly 2% to start reducing rates. It's got to be before that. But the dynamic in that precise moment will really depend on the context. So I can't say with any degree of certainty exactly when that will happen. But as we get closer and closer to that 2%, I think that'll be something that I'll have to take on board a lot more.
Well, your background is in housing, and so this raises the question of what happens to housing. People do not want to sell a 7% mortgage at this point and take out one and sell their 3%. So is housing basically in the dumper now for years to come?
Well, I hope it's not years to come. But look, we've had an extraordinary period with incredibly low interest rates, and a lot of people were fortunate enough to be able to buy homes and get mortgages at those low rates. That is our reality, and so there is going to be some rebalancing that needs to happen, and that'll happen over time. I don't think this is all going to happen in a 6-month period, but my objective right now is to get inflation under control so that our policy rates can get back to something that's lower than where it is now. And I'm hopeful that mortgage rates will follow that. And then we'll be back to a more normal housing market where people will transact and move and buy and sell as their life circumstance determines.
Well, then, a last question. When you get back to whatever normal is, should people expect it to be higher than in the last 10, 12 years? A higher interest rate, perhaps a little bit higher inflation rate, maybe growth, potential growth a little bit higher?
Well, I would expect, yes, higher than the last 10 years. We've basically been at zero. Zero, I don't think, is a reasonable long-run expectation for where our interest rate should be. So it'll be higher than that. But I really don't think inflation will be higher than our 2% target. We want to get there. And that'll be the goal. And if we get to that level, I think that sets up the U.S. economy for pretty solid growth over the next several years.
All right. Raphael Bostic, thank you very much, President of the Atlanta Federal Reserve. We'll send it back to you.
Our thanks there to Michael McKee. Of course, a great interview there with the Atlanta Fed President Raphael Bostic, saying that he is still expecting slow and steady inflation progress, but says that the Fed can get to 2%. Within his words, minimal pain. He also said that the Fed still has time to watch and be patient, but if inflation expectations do start to creep up, we've, quote, got to act. Katie Greifeld, interesting comments here, kind of in line with what we've heard from other Fed members, but I thought it was interesting. He said that right now there's enough economic support out there that the Fed can hold rates for about 8 to 10 months where they are right now.
He also said, too, that a policy shift would be warranted before inflation is at 2%. And that's kind of the tension that I've been thinking about. We think of all the price cuts, the rate cuts that are priced in next year. It's not necessarily a downturn that would get us there. It's just getting back to neutral.
Yeah, and we should point out, he said he's not expecting a recession. That's not in his cards. Another thing, though, he was asked a question about credit conditions. And he said that they are tightening. He basically said they definitely tighten and said there's more to come.
There's more to come.
Yeah.
Of course, he's saying that, of course, those previous rate hikes, they're still working through the economy. And this is what we're seeing. Basically, it feels like those long and variable lags have just gotten longer and more variable, given how less rate sensitive this economy is.
Well, the one thing he did say that I guess is an upside for the Fed is that some of those wage increases that we've been seeing, what he described as 10 to 15% salary increases, that is a thing of the past, and we're now reverting back to 2018 and 2019 levels. Stick with us here on The Close. Dana Doria, she's coming up next. This is Bloomberg. This is the countdown to the close. Romaine Bostic here alongside Katie Greifeld with about 10 minutes until we get to those bells. Katie, a strong rally here on this Friday afternoon, a strong rally for the entire week.
We have a lot of superlatives to talk about. You take a look at the S&P 500 right now, of course, solidly higher on the day, about 1% higher. For the week, you can round it up to 6%, which is quite a move. You can see that it has the blessing of the bond market, if you will, the 10-year Treasury yield falling another 9 basis points. We are at 457 right now. For context, remember, we were at 5% last week. And you take a look at the VIX, of course, volatility draining from this market. The VIX trading with a 15 handle. We'll see how low it can go, Romaine.
Yeah, absolutely. Here, an interesting week. The big question is, does this continue in the weeks beyond? Dana Doria joining us right now, co-CIO and president over at InvestNet Solutions, which has a little bit under $400 billion in assets under management. And Dana, let's start off here with some of the market moves just here on this day and really for the week. And I am curious as to what's driving it. Is this really about, I guess, the shift in yields, the expectation that the Fed is over, or about, I guess, just getting comfortable with economic conditions?
Well, I think part of it is just, kind of reversal after a series of bad sessions, and I think, we're seeing something similar in the bond markets, right? You have yields jump 100 basis points. There's going to be some retrenchment that kind of comes after that. So to a certain extent, I think it's just, the market overshoots, and this is, the world we live in, right? The market overshoots and then it kind of comes back a little bit. I do think, though, that you are getting some of this bad news is good news type of reaction because obviously we left rates as is. And the question is, what happens at the next meeting? Certainly, the jobs report that we just got signals that we probably won't get a rate hike next meeting. And has empowered Powell to kind of to keep it steady. So a little bit of expectation on rate hike and getting what we expected. Yeah. Certainly today, I think reaction to the jobs report, and then again, just maybe a little bit of calming down from some of the negativity that has been in prior sessions.
Well, I am curious too about just kind of the role of fixed income in the portfolio, particularly when it comes to government debt here. I mean, this was obviously, for a lot of folks, kind of a once-in-a-generation opportunity to lock in rates at relatively high levels, at least relative to what we have been used to over the past decade or so here. And I guess the big question now becomes is that for those folks who are playing this, less about buying and holding, locking in those rates, and more about trading, is there a role to continue chasing after some of these yields in the fixed income space?
Yeah, well, I mean, I think it's interesting, some of the quotes you're hearing in the media and pulling shorts off, not the time to short anymore. Folks who are, kind of getting behind the notion that, hey, getting back into the bond market makes a lot of sense. I mean, look, I think, again, when rates go up 100 basis points, all else equal, expectation is probably that more likely than not, they come down a little bit. It doesn't mean, that there's not a possibility of getting even higher. And, certainly we're still looking at inversion, right? So at the end of the day, you'd expect the 10-year at some point is going to be higher than the 2-year. But, the steepener that we've had lately, I think, if you're a betting person, which is, I think, take your question, I would guess rates decrease for a bit now.
And what would that mean for the equity market? Because for the past couple months, of course, the source of volatility for stocks has been in bonds. If we do get sort of a breather here in treasuries, yields continue to fall from here, what would that mean for equities?
Yeah, I think it would be somewhat calming to a certain extent, right? Although, obviously there's some interplay there of putting money in the equity market versus the bond market. But I think, there's a thought that, hey, there should be a negative correlation there between prices of equity and bonds. And to the extent that equities are experiencing volatility, I think bonds can be a dampener. I don't know that I think it works the other way around quite as well. So, but equity markets have a lot to contend with coming up. And, just looking at maybe we get an extension on the shutdown, but we've got 2 wars in motion, right? We have obviously lagged effects for monetary policy kind of coming in. And, there's a certain amount of it. It's not a good year to be a pundit on these things, right? I mean, you started the year with everybody kind of predicting recession, a half a year of just phenomenal returns, and everybody sort of starts shifting over to, hey, maybe we're going to stick this landing. But if what happened with the GDP report, for example, 4.9% seasonally adjusted. I mean, this is a fantastic GDP number in any kind of sense of, what we would expect in a year that following the kind of interest rate increases that we've seen. And the market kind of just shrugged that off. And to me, that says really kind of a signal that we've priced in a pretty rosy landing, and there's downside risk there. So I think equity markets have to contend with that.
Well, if there's greater downside risk than what's currently being priced in, perhaps, where do you see safety in this market? Where are you putting your money right now?
So, I mean, it's the tried and true stuff, right? Obviously have your bond position where it needs to be from a ballast perspective, right? Putting aside what you think happens with short-term rates. At the end of the day, have enough fixed income. And that's not as hard to do for the average investor as it was now that you're actually getting income on that. So I don't think there's, that shouldn't be as controversial maybe as it has been. But also, within equity markets, tilting toward, more traditionally defensive plays, right? Quality stocks, low volatility stocks, right? So the kind of boring consumer staples, utilities, et cetera, to a certain extent, not specific, names, but just kind of tilting a little bit toward that area, and maybe not thinking about tech as being the defensive play, even though, we've seen the Magnificent Seven kind of be this indicator of risk on, risk off. Certainly these, they're sort of fortresses to a certain extent, right? And understandable why people have kind of crowded in there in difficult times. But I think we're starting to see some of the cracks in that thinking, and certainly after the earnings season and what happened there and how that shaped up, indicating that maybe, more traditional defensive plays.
All right, Dana, great to talk to you. Dana D'Auria there of InvestNet Solutions. Have a wonderful weekend, helping us count down to these closing bells here on this Friday afternoon. And I think it's good we take a step back here, Katie, with about 3 minutes into the bells to kind of take stock of what we're actually seeing in the stock market today. A 1% gain on the S&P, 1.5% on the NASDAQ. But I thought this was interesting. Almost a 3% jump today on the Russell 2000.
I knew you were going to go there, and I'm glad you did. I was actually just looking at that as well, because small caps have been so beaten up. You think about this higher for longer narrative that has really put the pressure on some of these smaller companies. A lot of that is reversing today, and it remains to be seen whether that's sustainable or whether we'll regret this.
I think that's what everybody wants to know, because we've kind of been here before, where we've seen these spikes, and then of course it doesn't last for whatever reason or another. People get spooked and they move on. But I wonder if this has maybe a few more legs than in the past. All right, we are moving closer to these closing bells. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic. Welcome to our audiences across all of the Bloomberg platforms, television, radio, originals, and of course our partnership with those folks streaming this on YouTube. Carol Masser, about 2 minutes to go until we get to these bells here. And I was just talking with Katie here. The big outlier today are actually small caps. The Russell 2000 up almost 3%.
Yeah, really kind of roaring back here. And maybe it's kind of interesting, right? If things are starting to slow down, shouldn't that mean that the small cap should have a little bit of a harder time if the economy could maybe come undone? I don't know. I feel like there's a lot of mixed questions. We were just talking with Abigail Doolittle. Feel like, how much the sentiment changed in just 1 week here. Which one am I supposed to believe at this point if I'm an investor?
Yeah, she basically said that she spoke to sources today who gave her the idea that people should be cautious in an environment like this. I mean, Abigail told us, Katie, that when you think about a rally that's gone this far, this fast, and the way sentiment shifted in such a short time, some of this could be short covering. Watch out next week because a lot of the stocks that she's been looking at have hit resistance on a technical level, and they're not getting as high as they were getting before. So they could see a barrier.
And you have to weigh that, of course, with what's going on in the Treasury market as well. Just a breathtaking move lower in yields. And of course, a lot of that, too, might not necessarily be fundamental, but more of those technical and positioning factors that you're talking about. Yeah, I mean, and it kind of gets to this idea of if it does unravel and sort of what would be, I guess, the catalyst that leads to that.
We are getting the closing bells here in New York. Let's walk you through the numbers here. An up day and an up week for most of the major indices here in the U.S. We start with the Dow Jones Industrial Average, higher on the day by about 0.6%, up about 200 points, back above that 34,000 level, and adding to what is now gains of about 5% here on the week. Best weekly performance for the Dow going back to October of 2022. Meanwhile, the S&P 500 up 0.9% on the day. That's adding to about what is now going to be a 6% gain on the week, best week going back to November of 2022. And the NASDAQ Composite also getting in on the action, up about 1.4%. And again, once again, having its best week since November of 22. But look at this. We got to talk about the Russell 2000 here because it was an outperformer all day long, all week long, up about 3% here on the day. Its best day going back to mid-June. And on a weekly basis, an 8% gain appears to be locking in. Best week for the Russell, Carol, going back to February of 2021.
What a shift in sentiment, and going into a weekend, it's kind of interesting to see all this enthusiasm. You look at the S&P 500, 415 names to the upside, 85 to the downside. NASDAQ 100, you've got 84 names gaining today, Katie, and 17 to the downside. So really a risk-on trade once again.
Yeah, and you can see the same sort of story playing out in the industry groups as well. You have a bunch of groups higher right now. Leading the charge are those semiconductors and the semi-equipment companies. As I believe it, all of the names in that group are positive right now, leading it to a 2.6% rally. Consumer durables, consumer services, banks as well, also getting in on the action. Take a look at some of the losers. There's not many, just 3 out of 24, but it's tech, hardware, and right there at the bottom you have energy, not having too great of a day, down about 1% overall.
All right, so let me get to some of the individual gainers. Had a lot to choose from on this Friday, thanks to the rally. A couple of, I feel like a lot of experiential companies were definitely rallying in today's session. Expedia among them, finishing just off its highs of the day, almost a 19% gain, seeing this top among the major indices as well. We know the company reported third quarter earnings. They beat estimates. They announced a $5 billion share buyback. So that certainly, kind of juiced investors and made it more interesting as well. Live Nation up about 3.5% off its highs of the day, but also this company reported third quarter results that beat expectations. Analysts positive on the company's demand prospects for 2024. So a little bit of a feel of an outlook, certainly from the analyst community. Gartner, we don't talk about it a lot, but it's a pretty big company. It's a $30 billion information services and research company. It is top among the S&P 500, climbed to a record today after boosting its full year projections for revenue and adjusted EPS, so up about 14.5%. And Moderna, this was number one in the NASDAQ 100, rallying after taking quite a hit yesterday following earnings and an outlook that was disappointing. HSBC, though, upgrading the stock to hold from reduce, saying the downside has played out. So you can see that stock up just under 9% in today's session.
All right, well, let's go to the other side of things. In the S&P 500, the worst performer on a percentage basis, the cybersecurity firm Fortinet, finishing the day down by 12.4%. Shares fell, Romaine, earlier by as much as 23.4%. It paired those losses to close at just 12% lower. The company cut its billing forecast for the year after its third quarter billings missed the average analyst estimate. Let's take a look at shares of Apple. It's actually the worst performer on a points basis in the S&P 500 today, finishing the day down by 0.5 percentage point. We've been talking about it for almost 24 hours now. The holiday quarter revenue will be about the same as last year. We learned on the call yesterday. The company also reported its fourth straight revenue decline, streak that it suffered all the way back in 2021.
So all those IMAX and whatever they announced earlier this week, that didn't really move the needle?
I mean, those don't show up until next quarter, until the current quarter that we're in. But there's a reason. Mark Gurman talked about it.
What's that?
About rushing out those new Macs to help that sluggish PC market.
So people can buy those
for the holiday quarter. Yeah. Okay. Did you want a new computer for the holidays?
I mean, I wasn't asking, but since you're offering to.
All right, the wearables. The wearables.
Do you want a refrigerator, or what was the other choice?
I'll take the boat.
The boat. That's right.
I might get you a $7 latte instead, Romaine. Love you, but
I'll take it.
All right.
Ouch.
Let's talk Bill.com. Bill Holdings, the parent company of Bill.com, falling today, down 25% at the end of the day. At one point, it was down as much as 35%. That would be the worst intraday in the company's history. The company cut its annual revenue forecast. It also reined in its full year projection for adjusted EPS. We saw a couple analysts cut their recommendations on shares.
Yeah, we have to talk about what happened in the yield space on the day and on the week, because it was interesting to start to see this rally sort of take foot here, and maybe there are some legs to what we're seeing there. Most of the curve shifting on the day lower, as you can see there on your screen, down about 16 basis points on the shorter end. That's your 2-year yield, and it's down, of course, on the week as well by about 17 basis points. A similar move on the 10-year yield. It's down 9 basis points on the day, but about 27 basis points lower from where it was last Friday. And remember, it's about it had dropped last week by about 8 basis points here. So we're starting to see this rally take foot here, and it really kind of dovetails too, I think, with some of the commentary, I guess the tit for tat, if you will, that we've been seeing between Stan Druckenmiller and Janet Yellen about what's actually moving these yields. Of course, the idea that Yellen said is not really about Treasury supply, and I guess to a certain extent, Druckenmiller actually agrees with her. He says it's partly about Treasury supply, but it's also about deteriorating economic conditions.
Yeah, it gets back into that bond math, right? And of course, they're going tit for tat over that, like you say. But I mean, it has been really the story of the past couple months, this supply that we're getting. And let's not forget, of course, in addition to the Fed, in addition to today's jobs report, we also got the refunding announcement. And bond sales are going up, but not as much as expected. And you think about what had been priced in, this sort of worst case scenarios, and you could make a case that this is just a fundamental sigh of relief that we're seeing in the Treasury market.
I will say, when we were at the Schwab event last week, Kathy Jones, who follows the fixed income market, she said she actually was looking at Treasury supplies and went back several decades to try and find a connection in terms of impact on rates, and she said she couldn't find any. So, because we were like, well, what about Treasury supplies? And
it's a very EM sort of thing. Doesn't usually happen in the Treasury market.
Okay.
Yeah. Okay.
I mean, she kind of debunked it. Yeah.
Yeah. I mean, I don't know if the data supports it either, but I think everyone's looking for that narrative as to why things are moving, because they shouldn't move, at least not to the extremes that they've been moving.
Hey, what do you guys think of the Bostic interview that we just saw with Michael McKee? I thought it was interesting, a couple headlines that crossed during that interview, Romaine.
Yeah.
You know, first of all, the Fed doesn't necessarily need to wait until inflation hits 2% to start cutting rates.
Yeah.
And the fact that, I mean, you know, we spoke to Steve Matthews a little earlier, and he said, you know, Raphael Bostic might be able to sort of get up and do some sort of victory dance, because he's been talking about the data that we saw today for the better part of a year at this point.
Yeah, of course, he doesn't have a vote, so we should point out that, I mean, just kind of clarify that. I mean, obviously, his opinion still matters. But, I mean, I thought the idea here, though, also that him saying that, look, I mean, they have the luxury of waiting. I think he put a peg on it of something like 8 to 10 months, where the Fed can sort of just sort of stand and keep rates where they are while they wait and see. But the other thing I was interested in, too, was towards the end of that interview, he was asked about wage growth. And he kind of referenced this idea that those 10 to 15% salary increases people got, that's a thing of the past, and they were going to revert back to 2018, 2019 growth levels. And I went to look at the data because I wanted to see what the official data was. And that was like, we're talking like 3% growth rates on average that we saw back then. So that's a pretty big drop from what employers were having to pony up, if assuming that 10 to 15% was indeed what they were paying out.
Does Uncle Raphael come for Thanksgiving?
No. Well, you know, here's the thing. I'm positive that we're long lost, you know, cousins or something like that.
It's
and he's just in
differently.
denial, which is why he dropped the K from the end of his name.
Okay.
But I'm going to talk to him and see.
See, I was confused.
The family
'cause I
is ready
thought-
to welcome you back.
I thought Mike McKee was going to interview Romaine, so I was a little bit disappointed when Raphael showed
That would have
up.
been something.
Yeah.
Don't forget, I think we get that senior loan officer survey, right? Don't we get that on Monday? So that'll be a good indication of how.
We're still paying attention to the slews.
It's been a while.
I'm kind of glad. Are we almost past the, because everyone's talking about how the Fed's almost done and we're almost doing. I hope we're past the point where we're looking at these really small esoteric data
These
points
third-tier-
and trying to like make some sense out of what the heck is going on.
These
in the
small
world.
esoteric data points like you, Romaine. Just gonna say. They like you, I'm saying. You're kind of dissing them, and you're like, they
I
like
never know when
you.
she's complimenting me or insulting me. It's all just kind of a
Go
blur
buy
at
the
this
boat
point.
or refridge,
So,
okay? Just do that over the weekend. All right, guys, that's a wrap. Our
I
cross-platform.
can't afford either one of those, girl.
This economy?
Yeah.
All right, our cross-platform, radio, TV, YouTube, Bloomberg Originals. We will see you again next week, everybody.
Coming up, the serious discussion continues right here on The Close. Bob Diamond, founding partner and CEO over at Atlas Merchant Capital, is going to be stopping by The Close in just a second. This is Bloomberg. You always have to take these day-to-day market moves with a bit of a grain of salt because what happens today can easily flip to the opposite tomorrow. But overall, on a net basis, this was a pretty solid week for U.S. financial markets, particularly for equities and an S&P 500 that did break back above that 200-day moving average. That's the yellow line there. And you saw the breach just a couple of weeks ago that was causing a lot of concern here about a potential longer-term downtrend in the markets. At least for right now, that's turned into an uptrend with the S&P posting a 1% gain on the day and about a 5 to 6% gain on a weekly basis as well. When you take a look at some of the individual movers, believe it or not, the big gainers, it wasn't actually those magnificent 7 stocks. Yes, all of them did post some pretty healthy gains on the week, but you had names like Roku up about 50%. Yeah, it's a smaller cap company. Yeah, it doesn't have the weighting that's going to really move the market here. But you saw a lot of names in that space really get bid up. The Paramounts of the world, Warner Media, a lot of those individual names that had really been forsaken and forgotten, suggesting that some investors are willing to broaden out what they're willing to buy. What they weren't willing to buy, well, you see it there on your screen here. On semi, down about 18% on a weekly basis. A lot of concerns here about their outlook. People shedding the dollar and shedding commodities as well. A down week for both crude oil as well as gold, which of course had been on phenomenal runs in the weeks leading up to the month of November. Meanwhile, you take a look at the yield space and some of the big moves that we saw on a weekly basis. 16 basis points lower on the 2-year yield, 26 basis points lower on that 10-year yield. And then you take a look at some of the rate-sensitive sectors, which actually got a boost to the upside, Katie Greifeld. That includes REITs and that includes banks.
Well, let's bring this conversation to this week's Fed decision and the impact of today's jobs report. I'm thrilled to say Bob Diamond is joining us on set right now. He is Atlas Merchant Capital CEO and founding partner and the former CEO of Barclays. So we heard from Jerome Powell on Wednesday, seeming to indicate that they're going to stay on hold for a while now. Then you take a look at what we got this morning. That jobs report may be showing some cracks. You see a lot of rate cuts priced into next year. Is that premature? Did today's jobs report actually change the narrative that much?
I don't think it changed it a lot because I think the market was kind of 25, maybe 1/3 that there could be one more rate rise. And I think now there's one more FOMC meeting in December. I think we're done for 2023. So I think that probably solidified the fact that the pose is in place for the balance of the year. You know, I think when you look at the wage increases number, it's kind of like averaging around 4%, which is down much lower. That's fairly consistent with a 3% inflation rate. And although there's a lot of rhetoric about targets and 2%, frankly, if we finish this year approaching 3% in terms of inflation, 4% in terms of wage increases, I think the Fed will be delighted because it was in a much worse position not that long ago.
In a perverse way, what's not so delightful for the Fed is just how resilient this economy has been to 5 percentage point increase in that benchmark rate. When you think about that, what do you think explains it, that we haven't seen a broader cracking across the economy, even though this Federal Reserve has been very hell-bent on getting inflation back down to 2% and tightening those financial conditions?
Well, I think they're very pleased, first of all, Katie, that 525 basis point increase. This is unprecedented in such a short period of time. And the fact that the markets, both the fixed income markets and the equity markets, are in balance fine. And the fact that the economy in the U.S. is growing, I'll be very honest, I just got back from a trip to Asia and a trip to the Middle East, and people around the world are looking at, like, how are they pulling this off? So they did the tightening. Rates are at a more normalized level now. The economy seems to be doing okay. It's not like the markets are buoyant, but the markets are functioning. And I think it's a real credit to the U.S. economy. So I think, first of all, I think they're pretty pleased. Second of all, I don't think we've really completely adjusted to the new normal in interest rates, and I do think they're going to be here for quite a while. And I think there's more adjustment to be made, and we would expect to see, quite frankly, more cracks in credit. One of our 2 businesses is an opportunistic credit fund, and we're very, very, we're staying very liquid right now because we think the worst is ahead of us in terms of corporate credit.
I'm curious, is that because of the refunding needs for some of these companies, or it is?
Well, it's a host of things. It bears its head mostly in the conversation around commercial real estate, but it's similar in other areas. One of the things we love about investing in financial services for ourselves is we don't use leverage because we're investing in leveraged companies. And frankly, financial services generally benefit from higher rates. Other areas of investing, when the refunding comes up or new investing opportunities come up that require leverage, it's a much different scenario right now.
Well, I have to ask you a question then, because earlier in the day, we got some news that the Financial Stability Oversight Council, which is headed by Janet Yellen, basically they came to this agreement that they want to expand this umbrella of too big to fail to include non-bank financial companies here. The idea that private capital has become much more of a dominant player in our economy, and that the absence of regulation, at least in their words, could potentially pose some systemic risk. What do you make of that?
I didn't see that, but I can comment in general on it. I think if the regulators see pockets of financing, which if something goes wrong are systemic and can create systemic issues, then they absolutely should act on those. It's not clear to me right now that the private lending sectors create systemic risk if they begin to fail. But if that were the case, Roman, I would absolutely say that's ripe for regulation.
Let's talk a little bit more about private credit, because that's one of the big stories this year. Of course, the industry growing to $1.6 trillion. And the narrative has really been that they're taking market share away from the banks when it comes to this lending. And when you think about what happened in March, would we be having this conversation had we not seen that turmoil, or was this a sort of a natural sort of progression?
Listen, beginning in 2008, when there truly was too big to fail, we had two institutions, B of A and Citi in the U.S., that were it not for TARP, were insolvent. And that was going to create even a bigger crisis than what Lehman Brothers caused. The regulators have really been on this, which is that systemic risk, is the issue that they're most attuned to. So the capital levels for lending institutions, the deposit-taking institutions, have continued to go up. And we're seeing Michael Barr, now the vice chair, proposing even higher levels for the systemic banks. I think that's here to stay. And I think that's here to stay not just in the U.S., but in the major economies around the world. Here's the rub. What we have in the U.S. is an incredibly deep and diversified financial services industry, not just the banks. If the banks stop lending in Germany, then the economy gets impacted. And I think the fact that we have private credit, hedge funds, private equity funds, venture capital, so much diversity and so much depth to the capital markets in this country is one of the reasons that we're weathering these interest rate rises the way that we are.
That's a good point. But do you think that higher capital requirements actually reduce systemic risk? I mean, Jamie Dimon has made the case that no. Basically, once you get to a certain threshold of capital holdings, you've kind of done what you can do. And we were speaking with Dr Rajan, the former India Bank governor, and he kind of said the same thing.
Listen, it's not a simple answer, so if you give me a second. If I were CEO of Barclays today, one of the top 5 or 6 banks in the world, I think I would be saying exactly the same thing that Jamie is saying, which is factual. It will reduce the returns. It will reduce some of the lending. On the other hand, I'm not in that position today, and I think I have a different perspective. And if you look at the challenges that the regulators in the U.S. faced in 2008 around systemic risk, the banks in the U.S. today, the top 4 or 5, are bigger, more concentrated, have far more systemic risk than they did in 2008. And so the focus of, it doesn't mean they're about to fail tomorrow. In fact, I think the big banks in the U.S. are doing very, very well. But if you ask me, can we allow them to continue to get bigger and more concentrated? I think today JP Morgan has about 10% of the insured deposits in the U.S. market, something of that order. And if you think to the SVB situation, where people talked about the mark-to-market loss in their Treasury portfolio, well, the mark-to-market loss, this was reported in the B of A Treasury portfolio, was $100 billion. Doesn't go through the P&L because it's a non-mark-to-market book. So you have to consider that the banks are bigger, are more concentrated, and the single worst thing that could happen to our economy would be one of them tipping over or getting into trouble.
All right, Bob, we're going to have to leave it there. Great to catch up with you. Bob Diamond, Atlas Merchant Capital CEO. We'll be back in a moment. This is Bloomberg. Welcome back. Today we're launching a new series called Next Up, where we highlight the entrepreneurs and innovators moving the needle on trends in the market, technology, and the venture capital space. Who better to kick things off than with Sam Yagan? He's the CEO of Corazon Capital, which invests in other companies, but he has a long track record as an entrepreneur himself, the man behind such brands as Spark Notes, Meta Machine, and of course, I think one that we're all familiar with, OK Cupid. Sam, great to have you here on the program. And I do want to start with the sort of state of entrepreneurship and whether this type of companies that you were behind, that you were able to start up, turn into successful businesses and either sell them off or take them to the public markets. Is the environment today, and more importantly going forward, going to be conducive to that?
I think the market has never been more conducive to entrepreneurs building great companies. It is easier than ever to start a company today. I think back to starting OK Cupid in 2003, we had to rent servers. We had to code for 9 months before we could even have a product ready for users to start playing with. Whereas now an entrepreneur can be up and running in a matter of days or weeks with the product being able to use the cloud and all the advancements in technology. So I think it's never been a better time to start a company and never been cheaper to do so.
Can they raise the type of money that we got so used to seeing with some of these companies in the past cycle?
I think it depends a lot on where you are in the trajectory of the company. Seed capital is still pretty easy to come by because the market opportunities are so big and because so many huge seed funds have been raised over the last few years. I think the further you go, the closer you get to the public markets, the more we've seen the effects of the slower IPO markets and all of the pricing pressure that we've seen on valuations that have been widely reported over the last couple of years.
And Sam, where is that capital coming from necessarily? I see in your notes that you point out that likely in 2023, we're going to see once again a decrease from participation from some of these non-traditional investors. So who's actually stepping up here?
Well, we're seeing a lot of, again, at the early stages, we're seeing a lot of both angel investors, and we're still seeing a lot of traditional venture funds that are providing the capital to those early stage companies. The further out you go into the growth stage, what we're really seeing is companies slashing burn as much as possible. To the way I sort of visualize it is these companies are all holding their breath because they don't want to be in market anytime soon. I do think 2024 is going to be much stronger for growth stage startups because there's only so long you can cut costs and head toward profitability before you have to start investing in growth. Yeah. And I think these companies will be coming to market. And I believe that over the last 25 years, great companies always get funded.
When you talk about coming to market and we talk about the exit strategy, you think that is going to be with a kind of a reacceleration or renewed healthiness in the IPO market? Or are we going to start to see a little bit more M&A activity within the private space as an exit strategy?
Corporate M&A has been very, very slow this year, as you know. I do think it'll be a sort of a battle between the two. Corporates are going to start buying these companies, especially if the valuations continue to come down. Founders are going to be faced with choices. Do I want to raise at a what might be a down round? Mm-hmm. Do I want to take that dilution? Or do I want to go ahead and get liquidity for myself and for my investors? And I think there's going to be huge opportunities for corporates to buy at what will appear to be prices discounted relative to the last couple of years.
All right, Sam, I wish I had more time. I'm going to have to leave it there. Sam Yagan, CEO over at Corazon Capital, and of course, a very accomplished entrepreneur in his own right. He's kicking off our feature here. Next up, this is Bloomberg. Romaine Bostic here with a look at how markets performed on the day and on the week. A bid into equities believe it or not, a bid into bonds, and you saw some significant selling going on in the FX space with the dollar moving lower, and a big selling that we also saw in commodities with the big pullback in crude oil. But when you go back to what's actually wagging the dog here, once again remains yields. A 26 basis point drop that we saw just this week alone on the 10-year yield, and similar moves on other parts of the curve as well. That set us up for at least what today ends up being one of the best days for U.S. equities that we've seen in weeks, and one of the best weeks that we've seen in U.S. equities all year long. Katie?
Well, a lot of that comes back to what we saw in the jobs report, which was that job growth slowing by more than expected, and that the unemployment rate rose to an almost 2-year high of 3.9%. Joining us now to break it down is Julia Pollack. She is chief economist over at ZipRecruiter. And Julia, to borrow a word that you use in the commercial break, an icy report. But how noisy is it when you think about the impact of some of these strikes and labor negotiations?
Sure. So there are inevitable zigzags in these lines, but pretty much every indicator in the household survey and in the establishment survey points to a cooling, slowing labor market, even after you take into account those strikes. You had a decline in working hours, a decline in wage growth. Over just the past 3 months, wage growth has come in at just an annualized rate of 3.2%. Economists think that 3.5% is compatible with 2% inflation. So this is pretty slow wage growth given how tight the labor market is supposed to be. That increase in unemployment is worth looking at, especially for younger workers. And it's something to think about, because it was as low as 3.4% just a couple months ago in April.
Mm-hmm. Yeah, and when you think about that rise, I mean, still at historically very low levels, but to go from 3.4% to 3.9%, what sectors of the job market is driving that increase?
So the sectors that have been doing poorly ever since the Fed started raising rates are still doing poorly. The information sector is continuing to lose jobs. The goods-related industries like trade and transportation are still struggling now that consumers have shifted back to services. But even the service sector was somewhat weak. Manufacturing, the diffusion index for manufacturing dipped below 50. More sub-industries lost jobs than gained jobs by quite a large margin. And so that's looking pretty precarious too.
I'm curious, though, if you could just kind of square the circle, though, with the number of job openings, at least the official numbers, which I know a lot of people question as to how realistic they are. But even if you sort of adjust for that fact that they might be inflated, there's still a pretty big gap between what we're seeing in the unemployment space and what we're seeing in terms of job openings.
Sure. So job openings are about 33% higher now than they were before the pandemic. But the other indicators that usually move with job openings, quits, hires, they're all the way back to where they were before the pandemic. And so job openings do appear to be overstating the heat in the labor market. Our recent surveys of new hires and of job seekers see that they are feeling the pinch. Recently hired workers have lost some bargaining power and leverage in the last couple of months. They report getting signing bonuses in lower numbers, raising their pay upon switching jobs in lower numbers, being satisfied with their new jobs to a lesser degree as well. So they're clearly losing some bargaining power.
Well, and this kind of dovetails, too, with the conversation we had a little bit earlier with Raphael Bostic, the Atlanta Fed president, who talked about, in his words, what were like 10 to 15% salary bumps over the last couple of years, reverting back to 2018, 2019 levels, which would, at least based on the official data, put some of those average hourly earning increases somewhere in the range of about 3, maybe to 4% max here. And I'm wondering, that's a pretty big drop in a pretty significant amount of time. And I'm wondering if that matters. Does a change matter, or is it the longer term pattern?
Well, I think if you look at the long-term pattern, prices have gone up 18.2% since the start of the pandemic. And at the median, on average, wages have gone up only as quickly or less. For unionized workers and for public sector workers, they've gone up much less. Huge wage gaps have emerged, wage growth gaps between different sectors, different parts of the economy. We are seeing some catch up now in the public sector, and that's largely driving strong job gains in the public sector. The public sector was very slow to adapt adapt to the pandemic and to raise wages the way the private sector did. They're finally managing to do that now as these long-term contracts are coming up for negotiation, and the public sector is becoming a lot more competitive also as the private sector cools.
And Julia, I want to zoom out a little bit and talk about the balance of power in this labor market, because for a long time it seemed like the workers were in charge, and now outside of what we're seeing, of course, with the UAW, et cetera, can we say that the balance of power has shifted back to the employers, or what does that dynamic currently look like?
Well, it definitely hasn't shifted all the way back. There are enduring labor shortages in many sectors. They have eased, but not all the way. And workers are flexing their muscles. In this report, 96,000 workers were absent due to a labor stoppage. That is more than at any point since 1997. It's a huge number, much, much higher than what is usual. So it wasn't just the UAW strike, it was strikes across the economy, many, many smaller strikes that don't even show up in the BLS data, in hospitality, in healthcare, all over the place.
And this gets us to the broader question here, Julia, that if we do continue to see softness in the labor market, and particularly when it comes to wages as well here, how much can you sort of anticipate the feed through into consumer spending and maybe a correlated drop in that?
So in the latest data on disposable personal income, we did see a drop in real disposable income. And that does suggest that with wage growth like this, with slowing real wage growth, the consumer is going to increasingly feel stressed. Job seekers report rising rates of financial distress, and it's causing them to accept the first offer without negotiating. We saw a huge decline in the share of workers who negotiated their new offer in the last quarter. And that does suggest that wage growth pressure will continue to come down, unless, that is, rates start falling and that this story turns around sometime soon.
All right, Julia, great to catch up with you. Julia Pollitt there over at ZipRecruiter, a breakdown here of the big jobs report that we got earlier today and the feed through into other pockets of the economy going forward. We do want to pivot from that conversation to, well, something a little otherworldly. SpaceX set to launch 23 Starlink satellites to low Earth orbit. That's supposed to happen at about 6:30 p.m. Eastern time tonight. Now, just a couple days ago, I had a chance to sit down with Danielle Wood. She's an assistant professor and director of the Space-Enabled Lab over at MIT's Martin Trust Center, who kind of pointed out there's already thousands of satellites out there right now that are operating and thousands more that are dormant, raising a lot of questions about sustainability up on space as well as back here on Earth. Let's take a listen.
Data from space is really key to understanding long-term climate change and short-term environmental issues. In fact, I'm going to COP soon, COP28, the UN global meeting on climate, to talk about this issue. So satellites are a wonderful way to get a regular global view of what's happening in the atmosphere with greenhouse gas emissions, or with physics and what's happening with the weather, what's happening in the water, especially our oceans, our fresh water, and the land. We need to track how humans are changing our activities, what's happening with agriculture and mining. And of course, as climate change continues, we are seeing extreme weather, natural disasters. We need to respond to those, but also prepare for them. So we can see all this from space.
We talk about this idea of a space race, even a space economy. I think someone sort of threw out a number once, and they talked about a $500 billion space economy, and then they started talking about the total addressable market for whatever it is they're trying to do. What does that mean to you when you hear people refer to something that's still sort of ephemeral as an economy?
In every region around the world, I think of Africa, Latin America, Southeast Asia, countries and companies see space as part of their mission because they know that satellite Earth observation, positioning, and communication are vital infrastructure to make their businesses and governments work.
How exactly do you do that? Is this a cooperative effort, or are we just kind of doing this country by country, company by company?
I'd say in the Earth observation and weather sector, we have wonderful international cooperation. I'm leaving soon for a trip to Cape Town. I'll be meeting with the Group on Earth Observations, a major global public sector and public-private initiative where people around the world are sharing data, often freely, sometimes at low cost, so people can share data from the US, from Brazil, from Europe, from China, from Japan, and really work together on designing data systems. I'd say on the commercial side, you see much more business-oriented. There's a profit opportunity, so it makes sense. You see a private leadership in commercial services for communications. On the side for positioning, meanwhile, you have many utilities offered by public organizations, the U.S. government, for example, Europe, Russia. They're providing a free signal to the whole world, so it's different in each sector.
Does it matter, though, that a lot of the efforts right now are sort of being fueled, I guess, by private companies, at least here in the U.S. and to a certain extent Europe as well, by private companies? I mean, how much sharing is there going to be with, I guess, the governments or just broader society at large?
We've certainly seen an interesting trend where, of course, a few major companies led by people who have independent wealth are making some key investments in technology. But I want to note that they're doing it alongside policies made by the U.S. government.
They're supporting that for research, because I feel like some of these trips are more about tourism and just pleasure trips for those who can afford it.
It's a great question. I think we'll see a mix. For example, my research team here at MIT called Space Enabled, we would like to study the opportunity to use beeswax as a fuel for satellites. And for that, we would like to be able to use commercial rockets to do experiments and the space station and companies that help us get to the space station. So sometimes the same company that's sending a tourist on one day might send my experiment for research on another day. And of course, having a mixed market is good for their portfolio of opportunities. So you see a mix.
And that was Professor Danielle Wood, the director of the Space Enabled Lab at the MIT Media Lab. A great conversation that I had with her earlier this week at the Martin Trust Center out there in beautiful Boston, Massachusetts. All right, coming up here on the big program, our Wall Street Week Daily segment is up next. Katie Greifeld, and I have a feeling you should be doing this interview. The New York City Marathon is set to occur this Sunday, and I guess a lot of people are going to be wearing Brooks running shoes. We're going to talk to the CEO of Brooks Running in just a second. That's coming up on The Close. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day. And this is a big week here in New York City, where the New York City Marathon is set to be run here. I'm not sure, you're not in it, right?
I am definitely
this year.
not.
Okay,
Definitely
maybe next year.
Yeah.
But of course, a lot of us are going to be watching from the sidelines.
It's not easy to get in. There was a piece in the Bloomberg today that said it's harder to get in the New York City Marathon than
in Ivy League schools.
Exactly. So it's hard. So I wouldn't have made the cut anyway, but I'm not doing it. But we have somebody who really knows about this terribly well. He's Jim Weber. He's Brooks Running CEO. So Jim, welcome. Good to have you here. This must be a big event for you, being a running shoe company. So give us a sense of how important this marathon is and how it fits into the overall market for running shoes today.
You know, the racing side of things is a dedicated runner's game day. And so the marathons, the 5Ks, the 10Ks, they happen in all the local communities, but this one's special, right? It's one of the greatest marathons in the world, almost 50,000 runners. That's a very large race, and of course the whole city comes out. So this is one of the best marathons in the world, and the whole industry shows up here too. And of course, we have a lot of customers running on Sunday. It's a great event.
Well, what percentage will be wearing your shoes?
Well, last year they have high-speed cameras, so we knew last year that over 20% of the whole field was running on Brooks. So we might have 10,000 runners out there on our product tomorrow, or on Sunday.
50,000 runners is a lot of runners, but overall in the market, is it growing? Is the pie getting bigger overall?
Overall, it is. It's been growing 2 to 3% a year for 30 years. And COVID, it spiked and it came down a bit, but it's up again this year. Race participation is up again this year. So I think there were about 400,000 people in the United States that will run a marathon this year.
I'm curious, when you talk about customers, obviously we're talking about the serious runners, as David pointed out. If you're in the New York City Marathon, you got to be serious here. But obviously that can't be your whole market if you want to grow as a company. You have to appeal to maybe slobs like me who maybe just want to run on the treadmill for, 30 minutes and feel good about themselves.
That's what makes running is such a unique sport because it transcends the sport, even a marathon like this, and it's an investment in yourself. It's health and wellness and fitness and mental clarity. So for 40 to 50 million people run for fitness reasons, some to compete, but the fitness runner is the biggest part of the market. And of course, what's unique about our sport too is they need the best product. So it's a really unique sport in that regard.
I'm curious though, I mean, Brooks has kind of staked their claim on that more serious runner here. Meanwhile, you have companies like Nike, which of course has just broadened out, and a lot of their shoes they sell, they know are never gonna be used for running or athletics, any kind. They're fashion statements. And I'm wondering, have you ever thought about moving Brooks in that direction?
It's interesting because the performance running silhouette has got more engineering in it, more engineered materials design, biomechanical design. So we've been doing that for 50 years, and it turns out to be a fabulous walking shoe. It's a great hiker trail running shoe. And it's a great comfort shoe for people that have foot pain. So the performance running silhouette, the secret is we've always had walkers and casual people in our product because of the comfort quotient. So now what we're seeing is this category, these premium products, is bigger than it's ever been because of those second and tertiary uses. And so, yeah, that now what's happening in 24 is we're expanding our color assortment of all these key styles so that we call it wearable running. I call it an airplane shoe. So I came here with only Brooks shoes. Basically, it's an airplane shoe. So you can go to a casual dinner with it, and then you go to the gym and you run. So that's what's happening, wearable colors.
Pick up on Romaine's comment about engineering, or I'll call it technology. How important is that in what you're doing, and particularly in gaining market share against some of your big competitors?
Yeah, it's critical. This is the glycerin, and it's got a nitrogen-injected midsole technology in it. Bottom line, best cushioning we've ever had in a shoe. 40% lighter and more durable. You'll get more miles out of it. So shoes are getting better, and it's just exciting. There's a lot of innovation coming into our category.
How important is it that you have somebody win the marathon wearing Brooks? Because I think a lot of the pro runners actually tend not to run Brooks. Is that wrong? Serious runners do, but not so much the pro people.
Well, we count market share in shoes on feet in every category, but our own Des Linden won Boston several years ago, and she just won the Masters record in women's marathoning at Chicago a month ago. She'll be at the Olympic trials in a couple months. And Josh Kerr just became the world champion in the 1,500 meter running in Brooks. So we don't have as many as some of the other brands, but it's all about, for us, all we do is run. So we want front of the pack, back of the pack. We want everybody on our shoes.
I am curious. I mean, just looking at this shoe right now, and I think all three of us are old enough to remember when running shoes were just kind of these flat things. And they've kind of evolved to where there's all this cushion here. I mean, what goes into, I guess, the testing and the science behind that leads you to believe that this is a better way to run?
So 10 years ago, I would have been here with a minimalist barefoot shoe. And now we're in maximalist cushioning. There's trends that come through our category.
Because I was told that we're supposed to all run barefoot and that the cushioning is
and it wasn't true. So here's what came out of that. We went into the labs. We did clinical studies with hundreds of runners. There was no clinical research on barefoot cushioning. Here's what we found. Everybody has natural habitual joint motion, and we're all different. Cushioning is timeless for most people. They don't want to feel the road. They don't want to feel their feet. But everybody's unique.
Sorry, we're mindful you're a Berkshire Hathaway company. Warren Buffett always talked about having a moat around your business. How do you have a moat around that shoe?
You know what? It starts with runnability for us. Fit, feel, and ride. We're always trying to earn the second shoe. So if a runner, especially a frequent runner, they know at mile 20 if they'll ever buy that shoe again. And it needs to be trustable at mile 26. And if we can win that customer over, it's going to be great for everybody else too.
So we all know this business in some ways, but I don't know it as a business. What are the margins like? How capital intensive is it? Is it a good business? Is it a cash business?
Well, I think it's a great business, and I think Berkshire's happy with it too. I think our industry footwear is a good business, and especially if you can create loyalty around your product and get a repeat customer. So this category is special. I think it's a great business, but it's not easy. It's very competitive, and it's very inventory intensive.
Jim, it's really great to have you with you. Good luck in the New York City Marathon. We'll be watching for those Brooks shoes. That's Jim Weber. He's Brooks Running CEO. And tonight on Wall Street Week, we're going to be joined by two economists, Cecilia Rouse, former Council of Economic Advisors Chair and Brookings Institution incoming president, as well as Larry Summers. And then we'll have Henry McVeigh, KKR head of Global Macro and Asset Allocation, talking about investing in Asia. That's coming at 6 p.m. Eastern Time tonight, Romaine.
All right, no better way to close out the week than with Wall Street Week and David Weston, who, of course, joins us on the close every day for his Wall Street Week daily segment. Meanwhile, Katie and I will be back after the break, setting you up for what financial markets will have their eye on next week. This is Bloomberg. All right, a busy week here in financial markets. Next week's going to be busy as well. More earnings, including Walt Disney.
Yeah, we got the House of Mouse up on the stage. We also have UBS, KKR, Uber, just to name a few. Tapestry, an interesting read on the luxury segment. And then we have some Treasury auctions.
Treasury auctions? I thought we were done with all the Treasury refunding and all that. 3 years, 10 years, 30 years. What yield are they going to sell at?
It's a very good question. The past yields were some of the highest I think we've ever seen. So it'll be an interesting test of demand, of course.
Yeah,
too.
particularly given the big drop that we saw in yields this week. So we'll see how that feeds in to some of those auctions. And we're going to get more Fed speak, I'm told, including from, I guess, the one who matters the most, and that's Jay Powell.
The man himself, that's coming up on Thursday. Of course, we just heard from him, but maybe something's changed. We have the jobs report in hand, so there you go.
Well, who knows? I don't know if they're going to be asking like hard-hitting questions or not, but anytime he speaks, of course, the market will listen. And of course, also will be on that panel will be the Israel's central bank governor too. So obviously very timely to see how that economy is holding up in the face of what is now a full-fledged war there. And then later in the week, we're going to hear from Christine Lagarde at the ECB.
And that should also be interesting, of course. You think about the different challenges facing these banks right now, and whether we truly are at peak rates globally, maybe we'll be able to piece together that puzzle next week.
All right. Well, Katie, it's been a very wild week. I wish we had a few more seconds to talk about it, but I think we have to go. Balance of Power is coming up next here on Bloomberg. We'll be back next week.